Good morning, everyone. We are just waiting for a couple more members so that we have a quorum. So please just bear with us for a couple of minutes. Let me send you a couple of slides. Okay. There's Nick right here. Okay, great. Just click dial on it. Okay, perfect. Thank you. Nick.
Good morning.
Good morning, Madam Land Commissioner. I believe we have a quorum, and we are ready for you whenever you would like to get started.
Great, let's call this meeting to order and we'll take the roll.
Commissioner Stephanie Garcia Richard.
I'm here.
Treasurer Laura Montoya.
Good morning, everyone present.
DFA Secretary Wayne Probst. Nick Tejas.
Present.
Catherine Allen.
Present.
John Bingaman.
Present.
Kelly O'Donnell.
Present.
6 in the affirmative. We have a quorum.
I'm going to take this moment with my chair prerogative to remind everyone that's on the call, that are council members, to please respond to Francesca about our council retreat in July so that she can get dates set. The sooner we can get those dates set, the better. All right, with that, I'm going to move now to approval of today's agenda. Do I have a motion?
So moved.
So moved, Madam Chair. Seconded.
I think that was a movement moved by Member Bingaman, yeah, and a second by the treasurer. Can we take a roll call vote on approval of today's agenda?
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst. Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
That is 6 in the affirmative. Motion passes.
Great. Can we have a motion to approve today's, or sorry, the minutes from our November meeting?
So moved, Madam Chair.
Okay, we've got a motion from the treasurer, a second by member Bingaman. Can we take a roll call vote on approval of our November minutes, please?
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
6 in the affirmative, motion passes.
And finally, we need to approve the minutes from our December retreat. Do I have a motion to approve the minutes?
So move, Catherine Allen.
We have a second.
I'm sorry, what was the motion for?
To approve the strategic planning retreat minutes.
I'm sorry, Madam Chair, I'll second that.
Okay, we have a motion from member Allen, a second from the treasurer. Can we take a roll call vote, please, on approving the strategic planning retreat minutes from December?
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
6 in the affirmative, motion passes.
All right, we're going to turn it over now to our state investment officer for his briefing on agenda item 2A.
Thank you very much, Madam Chair. We realize this is a long agenda, and also, we barely have a quorum, so to make sure that we can get through everything while maintaining a quorum, I'm going to be very brief, and we're asking everyone to move expeditiously through the agenda. I just have 3 brief things. In case you didn't see it in the report that Charlie put out on Friday, we did cross the $60 billion mark for assets under management, so that's a huge moment for us. I also would like to announce to the council 2 recent hires. So one is Leonard Granados, who has joined our IT team. We are very thrilled to have him. I had the opportunity to work with him in a prior role, and he's a joy to have here in the office. And then I would also like to introduce Joel Salas, who recently started as the second member of our risk performance and analytics team under Nino Carpenito, and very glad to have that team filled out now, and really thrilled to have Joel here. I also had the opportunity to work with him in a prior role. The only other thing that I wanted to cover this morning was I know numerous members had received an inquiry about our investment into Pemberton and then an investment from Pemberton into Oscar Mayer. There were some allegations about labor practices at the Oscar Mayer plant in England. So whenever we get any sort of accusation against one of our fund managers, we do significant due diligence to see what the issue is, if it does impact us, and we talk to the fund manager. In this case, the investment that we made into Pemberton last year was into their Credit Strategic Fund 4, and that fund has nothing to do with Pemberton's investment into Oscar Mayer. Pemberton did make an investment into Oscar Mayer. We do still take the accusations of unfair labor practices seriously, so we did talk extensively with Pemberton about that. We are keeping an eye on the situation, and we'll let you know if anything more develops. But at this point, I just wanted to let all of the members know that our investment is not connected in any way to the situation at Oscar Mayer. We have no stake in that facility. With that, Madam Chair, I'm happy to answer any questions.
Do we have council questions for Mr. Clark? Hearing none, we will move to our Chief Investment Officer's report, agenda item 2B.
Well, thanks, Madam Chair, and good morning, everyone. I actually got a few notes for you today. So at this time last year, we sort of laid out what we thought we could see this year. Just, we don't make any short-term forecasts, but just sort of briefed everyone on how we thought the year could play out. And we pretty much got what we thought. So, we started from the premise that it was a presidential election year and an incumbent was running. Those two things together almost always produce positive returns in the stock market, pretty stable or even strong economy. and so forth. And that's pretty much what we got. GDP was around 3%, for the year. Inflation was pushed down, down around 3% also, right now. Short rates went up to 5%. We sort of had that in mind. In fact, we actually forecasted that one, which we normally don't do. And the 10-year, what came up between 4% and 5%, which we expected would happen if we got short rates up around 5%. So all in all, you could call the economy and the things around it, robust for the year, which was generally the expectation. We did have one surprise, and that was the stock market, up 35% for the year. Nobody had that in their forecasts. But a lot of that was the tech stocks, in particular those related to artificial intelligence. They did take a hiccup yesterday, and it looks like they may trend down here for the next few days while people digest that news, and we can talk about that if you'd like. But the rest of the markets, up 9% on international stocks, plus 5% on publicly traded fixed income, plus 6% on private fixed income. Cash came in at 5%. You know, we sometimes, people will ask about our cash balances, outside the office. John and I occasionally get a question on our cash balances. People sometimes look at it as uninvested if it's in cash, but we earned a 5% rate of return on it last year. Real assets were up 10, private equity was up 5, so very steady across the board. Real estate was still sinking a little bit. We had a negative 10% return on real estate. Thank goodness for us, that's a buying opportunity, and we've got cash to put to work. So I know Keith's been really active in that area. What's it look like for 2025? Well, the prognosticators start coming in about November, and they quit writing reports about January, so I've probably read 100. 25 from people I think know what they're talking about, and 75 to see what everybody else thinks. Volatility was the number one word probably in these reports. So people are expecting a volatile year in the market. But still a good economy, which we have not had a proper recession since 2008. But we're again forecasting another good economy in 2025. We'll have to see about that. I think the thing that wouldn't surprise anybody is high geopolitical risk. We thought that for the case last year. That's continuing this year. In fact, we had General David Petraeus sitting here in this room. In fact, he was sitting in this chair, and I feel a little bit smarter this morning. I think I know why. General Petraeus gave us a good geopolitical brief, and also thinks geopolitical risks are high going into the year. And then last, still the potential for some social unrest, just the change in administration and as divided as people are, and the pressure of still high prices relative to incomes, at least here in the United States. So there's some pressure in the social area also. So we'll see. Most people were thinking positive on the stock market. I think we got rates, both short end and long end, that'll still produce 5-6% returns from those areas. So it looks lined up okay, but there's just always that black swan event out there, and a couple of places it could come from, geopolitics or even internal social. One more note for you, as you recall, in the spring, starting in February and ending in June, we do what we call our spring macro package. So you're going to see the new long-term capital market assumptions from RBK. We'll run all 12 of our portfolios through those new assumptions so you can see what the impacts are on our potential investment returns. We'll be doing things on inflows expectation, intergenerational equity. We'll really go through pacing. I know everyone's interested in that, so we'll take a deeper dive on pacing. We're going to review again managing our excess capital. So 3 years ago, we came and talked to you 2, or maybe it was 3 meetings about what the heck do you guys want to do with this excess money here? We can't jam it in the private markets. We decided to kind of take a conservative approach and use stocks and bonds. However, we did research a couple of other things. Well, one, we could just jam it in the equity markets, which nobody wanted to do. Thank goodness. There's also strategies that we call a completion portfolio, and it's just a way of using publicly traded assets to try to mimic the returns of private assets. So we researched that 3 years ago. I just personally couldn't get over the hump, mainly because the performance of those strategies had all been earned during a period of 0% interest rates, very low inflation, low growth, and we were in a much different environment. So I just was a little bit concerned that we could see a different pattern of returns from these things. I've been monitoring it the last 3 years. It has been coming out okay. So Kyle and I are looking into that again, and we'll present that to you in April, what those strategies are, what they look like, and how potentially we could use them. So lots of things. The annual investment plan, which will be our 14th, we'll have delivered to you in June. So, Madam Chair, that's the comments I have. Take any questions that you have.
Questions from committee members? Oh, Member Allen?
Yes, just a question. We talked last time about inflation, and I'm already hearing, like, in California, about 40% of the workers are not showing up in agriculture. The same thing's 26% in Texas. That's going to impact food prices. And then also the bird flu is impacting, in fact, you can't get eggs in some places. So how is that going to fit in?
Well, I think there's a push and a pull on the food prices. So I saw the same numbers that you did on the labor side. But it looks like we could get a reduction in energy costs, which is a big component of food price transportation. There's a little bit of a push and pull there, so we'll have to see how that goes. Overall, we think inflation is going to be pretty sticky and stay a little higher than what people think. We just don't think the Fed is really going to raise interest rates into this, and that's about the only thing that could push inflation down. Now, we did have Blackstone in here 2 or 3 weeks ago. They literally own 20,000 companies in their portfolios. They're saying that there's no push from labor for wages to go up, and very little, and it's pocketed. So there's not a great deal of push there. And input costs are coming in lower than their CEOs were. So what they were saying is inflation could wind up being a little bit lower than what people expect, just based on what they're seeing at the company level of all their investments. So we'll just have to see. We're still thinking it's going to stay in this three-ish range for a little while.
Anything further for Vince? Hearing none, we'll move to agenda item 3 and hear from our, oh, I'm sorry, I'm skipping RBK. I apologize. We're going to go now to our performance report, agenda item 2C.
Thank you, Madam Chair, and good morning, everyone. Today we do have the November performance summary. It is a non-quarter end month, so we don't have all the private market data. We'll try to keep it brief, but certainly look forward to bringing you the full executive summary next month.
And sorry, just a quick request, if everyone could speak up a little bit because of the microphone system we have in this room.
Sure, yeah, absolutely. So just taking a brief look at page 3 and recognizing that November feels like a while ago, some of these themes that Vince had mentioned certainly played out through November and December. We'll just try to tie that through the markets and into your performance. You can see there at the bottom right, the market performance table, that all the capital markets, by and large, reacted quite positively in November, in large part due to some of the pro-business policies and the impact of that from the administration and election results. A lot of that cooled off pretty quickly in December, even though we saw some strong numbers in November, as it became clear that the Fed was likely going to have fewer and slower rate reductions in 2025, in part because of the more persistent inflation that Vince had mentioned. But as you look at your performance for November and in the materials that follow that Marcia will touch on, I think you'll see favorable performance results. In particular, small cap did quite well. Small cap was anticipated to benefit from deregulation, also some other benefits in terms of being more sensitive to changes in domestic policy. So there was quite a bit of tailwind for small cap, but whenever you see big numbers, there's of course room for that to swing the other way, and that's exactly what we saw in December. And then emerging markets is another area that sticks out here in terms of more negative results, and it's almost the exact opposite of what was driving small cap, the potential for tariffs, strong U.S. dollar, all the things that tended to benefit small cap were working against emerging markets. But overall, your portfolio did quite nicely and added to gains from earlier in the year. And then moving into December, as I said, certainly a different environment with the Fed signaling the way they did. That pushed long end rates up, which then had a negative impact on the bond market. So you'll see that flow through in the Q4 data that we'll show you next month. One big takeaway, and we've talked about this in the past, is that your public and private market fixed income exposure are very complementary, and when you have this type of volatility, again, Vince mentioned volatility seems to be certainly an important topic currently with all the uncertainty in the markets and around rates. It's a good structure to have in place for this type of environment that we're in. Did finish our capital market expectations for 2025 going forward. We're in the process of customizing those for your specific exposures, and we'll look forward to bringing you those results in the coming months. So I'll take any questions after Marcia goes through the portfolio performance.
Thank you. On page 27, before I start, we want to let you know that we've been meeting with Nino and his staff and with investment operations to redesign the executive summary, and also that will fall through to the flash. One thing that was asked and we'll be doing is grouping the funds by assets. So we'll be highlighting in these flashes the land grant, the severance, and early childhood going forward. So we're incorporating what we've heard from you, and be patient. There's a lot to discuss, and we want to make sure we're all on the same page. But with that said, going back, as Matthias said, to November, on page 27 at the bottom, you can see performance through November. I will say that land grant on both a growth and net of fee basis has outperformed the benchmark through the 5-year and matched 7 and 10. Severance outperform in near term, longer term. It's on a gross and net basis has underperformed, but that's in the past, and we see the trend improving. Then you see the numbers there. Calendar year to date, land grant was at 8.71, 8.64 net of fees. Severance tax was at 6.9, calendar year 7.62 net of fees. The following pages are looking at asset allocation. You can brief through those and go to 31, but on the allocation, you'll notice that there have been some rebalancing going on. So that's an improvement. We'll spend more time on that executive summary. But going to page 31, just want to point out this is showing by fund, and this will be redesigned as well. The top is looking at the total portfolio through November, so the 11 months of 2024, your net cash inflow has been over $5.5 billion, and the gain of the total fund has been $4.4 billion. So understanding the growth now, at this point, it was at the end of November, over $59 billion, and as John pointed out, you're over $60 billion. Just a couple comments on just the composites on page 34. Vince had mentioned the strong performance. If you look at the calendar year and the 1-year returns, you can see some of those numbers. For example, U.S. equity calendar year, so 11 months, your portfolio returned 27.5 for public U.S. equity. For public non-U.S. equity, just under 13.9. Fixed income public was at 8, and although you trailed your benchmark, your new benchmark on private, you can see that having private was additive, outperforming your core fixed income portfolio. And then through this period, you can see cash calendar year to date at 5.9%. The following page looks at privates. We won't talk about that, but if you do go to the next page and look at the very bottom, you'll see we always point out the severance tax private program. Again, we'll have more information on that when we have those marks, but the ETI is at the very bottom, showing 0.84 positive for the month and a negative 4.96 for the 11 months of 2024. With that, we're happy to answer any questions, and we'll have more information for you at the next meeting.
Questions for RBK? All right, now we will move to agenda item 3 and hear from our investment committee chair, Member Bingaman.
Thank you.
Thank you, Madam Chair. We had an investment committee meeting last week. Member Tejas, Member Ulrich, and I were in attendance along with Treasurer Montoya. So we did have a quorum. We did recommend each of the voting items to the full council unanimously. We went through a number of, private market investments, as we often do. We also heard from Director Dunn on the international equity diligence review and prospective portfolio, and recommended that to the council, and would just note in advance of that discussion that we consider the managers there that we're going to be hearing about today really as part of an overall package. There was a lot of thought put into the overall portfolio construction, and that's why it's presented on a consent agenda today. We really think that, we need to think about these managers really as part of a package. So with that, I'm happy to take any questions.
Questions for the chair of the investment committee? Hearing none, let's move into the first of our voting items. It looks like a contract renewal. Director Lofton.
Yes, thank you, Madam Chair. So I'd like to point out that the first two items on the agenda today for public debt, I think in the agenda it's labeled private debt. These are two public debt items. So with me up here, Ryan McCauley, SIC fixed income analyst, and Matt Sturdivant from RVK. As you mentioned, Madam Chair, this is for a contract renewal. The SIC has a passive U.S. Treasury strategy. Oh, and we're on page 61. Apologies. The SIC has a passive U.S. Treasury strategy in the core pool within the public market debt allocation. That contract is up for renewal. Again, this is a passive strategy meant to mimic the Bloomberg U.S. Treasury Index. Therefore, there is no active management component to this strategy. SIC staff recommends extending SIC's contract with BlackRock Institutional Trust Company regarding the management of its passive U.S. Treasury Index for a period of 3 years, expiring January 31, 2028. The manager's performance has been satisfactory, and staff, in consultation with RVK, believe that the fees charged are competitive within the marketplace. There are no substantive changes to the contract terms. At least no substantive changes are expected. There are some revisions that staff initiated to make the guidelines to attempt to improve clarity, update the language for regulatory needs, and really better define the investable universe of it. Just make things more clear, take out some language that didn't necessarily need to be there. With that said, that's the full presentation.
Lots of questions. Hearing no questions, do we have a motion?
Madam Chair, I can make that motion. Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight from RVK, I move that the State Investment Council approve a renewal of the SIC contract with BlackRock Institutional Trust Company for management of its U.S. Treasury Index strategy, as discussed and memorialized today by the Council, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Do we have a second? Okay, we have a motion, proper motion by, member Bingaman, second by member O'Donnell. Any discussion on the motion before the council? Hearing none, we will take a roll call vote.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
6 in the affirmative, motion passes.
We'll move on to agenda item 3C, which is an RFP recommendation. Director Lofton.
Thank you, Madam Chair. Once again, this is a public, debt, recommendation. So this is for the multi-asset credit, manager RFP completion and recommendation. We're starting on page 65 of your materials. The two representatives, from the manager, Brown Brothers Harriman, that were chosen by staff and RBK, Andrew Hofer and Preston Johnson. They intended to be here. Their flight has been delayed, so actually they may walk in any minute if there are any questions. But luckily we have Mr. Sturdivant on site today. It's really nice to have him here, so thank you, Matt. So within the Credit Plus pool of the public debt market allocation, SIC has one manager, Shankman, for its liquid multi-asset class strategy, or MAC strategy. Shankman, in staff's opinion, has done a very good job for SIC. Nonetheless, the amount Shankman is managing in this strategy has more than doubled to over $2.5 billion. Therefore, staff felt it was prudent to add another manager to the strategy for debt. In August 2024, consistent with the principles of prudent manager diversification. Apologies, I lost my spot here. With prudent manager diversification, staff notified SIC of the MAC RFP issuance and the key steps in the evaluation process. The council issued an RFP in September 2024. Staff and RBK evaluated submissions in response to the RFP. There were 48 responses that were received, with 35 that met the minimum qualifications. From that, we came down to 8 semifinalists and 4 finalists in separate rounds. After interviews, review, and discussion, the committee selected Brown Brothers Harriman and Company, BBH. BBH manages over $70 billion in assets with offices worldwide. BBH has had a multi-sector credit strategy since 2014. And their multi-sector management team averages 29 years investment experience and 10 years with this strategy specifically. With that, I'm going to turn it over to Matt, if you have any comments.
Thank you, and it is a pleasure to be back here. I don't make it out too often, but I've been coming here for 15 plus years to work with you all. And the reason you don't see me too often is because of the high quality work your team's doing. But it's great to be here today. And just to pull out a couple of points to emphasize from what Tom said, this was a very well prescribed RFP process, 48 respondents. That's a good problem to have. We worked together to get down to a more manageable list to do full evaluations on. This is a unique type of exposure for a portfolio. It is a type of asset class that is seeking to provide investment in a variety of different securities. And that includes things like investment grade credit, high yield credit, bank loans, or securitized credit. And to do that, you have to have scale. So when we're going through an evaluation of manager for this type of asset class, we're trying to make sure that they are top tier in each of those areas. Now, Brown Brothers is a unique firm. It is scaled, but it is also privately held. So it is been that way since its founding, and it is a privately held company, and to us, what that means is that, in effect, they control their own destiny, and they are aligned with clients. There aren't other investors outside private equity or things of that nature. And that flows down to the investment team. What they've done over time is, with the success they've had investing in fixed income, they've built out an experienced and broad group of investors across portfolio managers and research analysts, and that allows them to cover a lot of different areas. And that depth, that team depth, is certainly a key attribute that we view positively. But another one is, alongside those fundamental analysts, the analysts that are really going in and figuring out whether a company or an issuance is high quality and has a very attractive relative valuation, and this is, I think, a differentiator versus some others, is that they also have built quantitative tools alongside that allows them to keep it all in front of them. Because when you're trying to look at a lot of different areas, you have to make sure that you're cycling into the right types of investments at the right time when they're more attractively valued. This combination of both team depth and good quantitative backdrop is something that has allowed them to have strong historical performance. And finally, last thing I'll touch on is just the performance rated very well, and thanks to the negotiation of your team, your staff, it's coming in at a very attractive fee versus other peers within this space. So wrapped up all together, we feel like it's a very good complement alongside Shankman. And again, this isn't because Shankman necessarily is used negatively in any way, but as the assets invested in this space continue to grow, it's prudent to diversify and find a manager like BBH that works well alongside Shankman, and that's the case here. So I'll pause there in case there are any questions on anything I touched on.
Questions from council? Hearing no questions, do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, advisors RVK and SIC staff, I move that the State Investment Council approve the selection of Brown Brothers Harriman and Company to manage a multi-asset credit strategy as discussed and memorialized today by the Council, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
I'm sorry, I didn't hear who made the second.
Kathy Allen.
Oh, yeah, okay. So we have a proper motion by Member Bingham and second by Member Allen. We also have just been joined by DFA Secretary Probst. So if we could include him in the roll call, please. We could take a roll call vote on this motion.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Probst,
Secretary, I think you're muted.
He's signaling a thumbs up.
Thumbs up. He voted yes.
all right. Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell.
Yes.
7 in the affirmative, motion passes.
Thank you so much, and thank you to the representative for being here. We'll move on now to agenda item 3D, and we'll call on Director Cassidy for the next 5 voting items, beginning with Bessemer.
Morning, everyone. We have 5 investments this month. 3 of them are venture capital funds, and 2 are lower middle market buyout funds, effectively.
Director Cassidy, it's hard to hear you.
Better?
Thank you.
I'll try to speak up. Sorry about that. So the first investment, we're recommending a commitment of up to $40 million to be Bessemer's second India fund. My memo is a little longer than normal this month. And I think it's kind of difficult to fully understand this particular Bessemer fund in isolation without understanding the broader Bessemer platform. And this is a group that we intend to pursue investments across their platform over the cycle. You know, we view Bessemer as one of the great classic investment partnerships in the world, along some of the other managers in our portfolio. This is a partnership structure that's withstood multiple succession periods and is just an incredibly well-run firm. Asia represents about 19% of the Burgess Venture Capital Index and 6% of the buyout index. So we'll selectively make investments in geographic kind of Asia-focused funds such as this. We tend to have a bias for funds with global platforms like Bessemer. So just to give you some context, some of our managers in the venture capital and growth equity portfolio look at Asia as part of their global mandates. This would be our first investment in an India-focused fund. As Vince has talked about a lot, it's an area of the world that we've been trying to figure out how to put more capital into. There's a lot of great demographic trends in this country, as well as just kind of an exciting and developing tech ecosystem where we think it makes sense to have exposure as part of a global portfolio. I'll pass it along to Richard to talk about the Mercer process.
Thanks, Chris. As Chris mentioned, we do have 3 venture capital funds we're presenting today, and we're excited about them. 2 are new relationships in the national program, and one's an existing relationship, but a new fund line that we're committing to today. Bessemer is a new relationship. We're seeking up to $40 million for Bessemer Venture Partners India Institutional 2. Bessemer Venture Partners is one of the longer standing venture capital firms. They started operating independently in 1981. The firm has a global presence with 9 offices across the world, including one in India. They have this culture of mentorship at Bessemer that really allows promotions to partners, and we've seen this on the India team as well. Because one of the current partners on the India team actually started as an analyst in 2014 and then was promoted up to partner. The investment committee at Bessemer Venture Partners for the India Fund currently consists of 2 partners in India and 3 partners from the US. The strategy focuses on early stage companies within India. It follows Bessemer's broader strategy of thesis-driven investing, which creates investment roadmaps to help the firm target areas to invest. In India, their current focus is consumer, enterprise software, fintech, and health tech. And the fund is going to benefit from being part of the Bessemer platform, where companies can benefit from the functional experts and operating advisors that they have relationships with. Performance is still developing for many of Bessemer's India investments. They do have a number of companies performing strongly, although the track record is mostly unrealized at this point. One note about the fund's terms too, the general partner is making a sizable commitment to the fund, which is higher than what we typically see in the industry, which is a positive for alignment. So we're recommending a $40 million commitment to the fund, and I'll turn it over to the Bessemer team for a short presentation, and then we're happy to answer any questions.
Thanks, Chris. Thanks, Richard. And hi, everyone. I was going to plan to share some slides, but I don't think I'm able to. So hopefully you can still get the story. But thanks very much for the time. Obviously, we're hoping to be there in person, but it's good that we have Zoom for these types of things. I'm Anita Umarji. I'm a partner and head of investor relations and fundraising at Bessemer Venture Partners. I'm here in our New York City office. Also with me on the Zoom is Scott Ring, one of our managing partners, a chief strategy officer, and member of our India steering committee. Many of you have already seen the slides, so we're just really going to cover some high-level points and key points. I'll start with some of the background on Bessemer that Richard and Chris already kind of alluded to, and then I'll turn it over to Scott to focus more on our India strategy, which we've had for almost 19, 20 years. So just for some context, our history dates back over a century to Henry Phipps, who was the co-founder of Carnegie Steel. He launched a family office, Bessemer Securities, which was named for the steelmaking process, and laid the foundation for our origin story and key aspects of our strategy today, which include innovation, sustained motivation, alignment, relentless focus on talent development, as you heard, and a really deliberate approach. The investment team of the family office spun out in 1981 as Bessemer Venture Partners, a completely independent entity with no ongoing control or ownership from the family. However, the handshake agreement was that the Phipps family would be our only LP for as long as that relationship could continue, and they were for almost 30 years. In 2007, we first decided to open up the funds to other LPs, and the Phipps family continues to be a very valued LP of ours alongside many others. Today, we're a firm with about $18 billion in assets, operating as a partnership with no CEO in 9 offices located at innovation hubs across the world. We've scaled quite deliberately over the last 20 years, expanding only when a boots on the ground presence or a dedicated fund structure best serves our strategy. As I believe Richard mentioned, most of our investment partners join the firm as analysts or associates. Our talent development and investment approach is truly unique in the venture capital industry. All analysts who join Bessemer have a clear path to partnership, though in reality, most won't get there. It's really difficult. We have developed a true meritocratic system with transparent deal attribution, where partners have autonomy within allocated capital budgets. However, the investment performance of those partners directly impacts their capital allocation and their budget. So it is a true meritocracy. For the last 4 decades, we've also employed what we call a roadmap-driven investment strategy, focusing on envisioning the future of specific technology areas. It's a really flexible approach that evolves based on emerging opportunities, and it's a collaborative approach with partners working across multiple roadmaps. And as you probably saw in our deck, we have our atlas, which represents the roadmaps we're currently focused on. And you can see that AI, while being a transformative force across all of our roadmaps, we've also developed specific AI-focused roadmaps as this paradigm shift continues. And then obviously, as LPs, you care about results. We have a slide on this in our deck, but all of these ingredients that I point to have resulted in a strong track record of making really good investments at the intersections of market downturns and technological paradigm shifts. And of course, the VC industry has faced some challenges in the past couple of years, but our partnership, which has withstood many challenges, has never been more optimistic about the opportunities ahead. And then before I turn it over to Scott to focus on India, I'll quickly summarize our fund platform. As you heard from Chris and Richard, we'd love to build a relationship with New Mexico that spans the platform as it makes sense. But essentially, our platform has evolved from one fund, our flagship fund, with 3 other dedicated funds that have all kind of spun out of the flagship fund. So I'll start with Forge. It's the least related to this opportunity, but Forge is our growth buyout strategy for lower middle market growth software companies, where we would actually take a majority or significant minority control position. Our flagship fund is the original multi-stage, but primarily early stage venture capital fund, now investing its 12th vintage. We have a fund called Century. It's a double down fund alongside the flagship fund for high conviction growth opportunities. And finally, we launched a dedicated India fund in 2022, building on our success on investing in the country since 2006 out of the flagship fund. So Richard is right, India Fund 1, most of the track record's unrealized, but the good news is that we have a track record in India going back almost 20 years, and we've had lots of great liquidity in those investments, which Scott will talk about. And so with that, I'll turn it over to Scott to frame the India opportunity and to provide an overview of our strategy there.
Thank you, Anita. It's great to see everyone. So just for context, I recently had my 21st anniversary as a BVP partner. And to timestamp that, the first investment we closed after I joined BVP was our seed investment in Skype, which was ultimately a $3 billion exit and 100x return. And so while we've had many other milestone events over the years, today, though, I'll just be talking about our investing in our latest India dedicated fund, and I'll do this in 3 chapters. I'll start by covering our history investing in India, although I need to touch on some of it. Next, we'll discuss the unique opportunity that India offers for venture more broadly. And finally, I'll close with some highlights on our strategy and performance. And so I'll kick it off with discussing with how we've adapted over the years. As Anita mentioned, we first planted our roots in India 19 years ago. At that time, India possessed a non-existent digital economy, little mobile penetration, a poverty rate 8 times that of today, and the 15th largest economy in the world. So our focus wasn't tech then, it was on later stage infrastructure opportunities. And as India's tech economy began to emerge in 2011, we took the lessons we learned from these early experiences and applied them to the current early stage focus strategy we use today. And so fast forward to today, India is now not the 15th largest economy in the world, it's the 5th largest, and it's projected to become the 3rd largest by 2028, which would trail only US and China. And we can go into many details of what's driving this incredible momentum, but I'll focus on what we see as the 3 key pillars of growth. First, there's been an unimaginable shift in India in wealth and demographics. This has resulted in a massive thriving middle class now amounting to over 500 million people. There's also been an astronomical expansion of the internet economy in India, one that we expect to grow from 175 billion today to over $1 trillion in the next 5 years. And then finally, we've also seen phenomenal growth in the software markets. This is a category we expect to eclipse 50 billion in ARR during that same time period. And the notorious income pyramid that's associated with India has now actually shifted to more of an income diamond with this really large middle class that I mentioned. And what's more is that about 50% of India's population is under the age of 30. These are digital first consumers that are driving the economy. And that is, just as a frame of reference, is 7 times that of the US market. And importantly, this young talent's also flooding really important innovation markets. There are more AI engineers in India than anywhere in the entire world. So now looking at capital markets, India has the 4th largest in the world by market cap. This opens tremendous opportunities for liquidity that we've taken advantage of over the years by taking 8 companies public. And notably, over the last handful of years, these markets have become even more stable than they were before. Just to give you a frame of reference, about a decade ago, Indian markets would falter if foreign investors pulled out. And to give you an example, during the GFC, FII dropped $10 billion, Indian markets dropped 40%. Now today, the story is very different, lots more stability and growth. In 2022, FII dropped 40 billion, Indian markets did not budge at all. And this is happening in part it's happening for a few reasons, but in part it's happening because of the massive $1 trillion domestic base that's emerged in India, mostly driven by retail investors. This is having them shifting from storing their wealth in gold and cash and investing in mutual funds and systematic investment plans. And so just overall, from a macro perspective, India is poised for dramatic growth ahead, very incredible growth, lots of innovation, and with capital markets the way they are, very robust opportunities ahead. And so now I'll move to the last section on strategy and performance. Our India strategy is very closely aligned with what Anita outlined. In our venture strategy, it's primarily early stage focused. We aim for meaningful ownership, and we double down on our winners as they scale. It's also a roadmap driven approach, just like our flagship funds. So it's primarily focused on 4 main roadmaps in terms of the consumer, digital health, cloud, and fintech. Now today, while there is a number of players in the India market competing in venture, we are unique in that we're the only fully integrated global firm in the market that can support our companies through the initial early stage investment through their entire life cycle. And that positions us very uniquely relative to peers, helps us win deals and impact outcomes with the ability to support our companies consistently. We're distinctive in the market for many other reasons, but today I'll just focus on the global integration of our team just in the interest of time. Our strategy is led by Vishal Gupta, also includes a broad team of investors, including one other investing partner, as Chris mentioned. Vishal joined us in 2006. We also have strong operational leaders with very deep experience structuring investments, engineering liquidity transactions, and the like in India, which is very important in that market. But our global integration overall is what's truly unique. This includes coordination on roadmaps, also coordination on investment diligence with our experts in global roadmaps around the world. Also includes support from our global network of 50 operating advisors and over 2,000 operating executives who help us on impacting outcomes and winning deals. And all of this is guided by a steering committee on which I serve. This committee collectively has about 100 years of experience building our venture platform. In terms of performance, we've built a formidable track record with the tech-focused roadmaps that I'm sure you've seen in the data. But just important is we're excited about the momentum in the portfolio and how that positions us in the market. The most telling evidence of this is our liquidity results. We're debunking the myth so far that liquidity is hard to come by in India. We've generated almost 800 million in liquidity for our LPs, including 300 million in gains over the last 3 years, almost 300 million. This has generated 8x multiple in those deals. And we're also excited to have one of the industry's most promising India-focused portfolios. I'll highlight 2 companies really quickly that highlight our best near-term IPO prospects. The first is Perfios. This is the largest fintech SaaS business in India. It's valued at more than $1 billion, more than 8 times our cost basis. The second is Urban Company. This is India's largest home services company. Think TaskRabbit in the US. We're holding this one at a $1.7 billion valuation and 11x MOIC. Both are profitable at scale, both have impressive growth, and we've taken a modest amount of liquidity in each. We still own meaningful positions in both of them. So to close, as you can see, we're just really excited about India and the prospects ahead. Anita and I want to thank you for your consideration and interest in our funds, and we look forward to collaborating with all of you on this and other initiatives in the years ahead.
Open up any questions if the board has any.
Council questions? Hearing none, do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $40 million to Bessemer Venture Partners India 2 Institutional LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
All right, we've got a proper motion by the Chair Bingaman and a second by Member Tejas. Any discussion on the motion before the council? Hearing none, we'll take a roll call vote.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Getting into my business now.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell.
Yes.
7 in the affirmative, motion passes.
All right, thank you. And we thank the folks for being on with us for the presentation today.
Thank you.
Thank you very much.
We'll move on now to agenda item 3E, Fraser.
So we've talked about Fraser a lot in the last year. On page 169 of the materials, Fraser Life Sciences, last year we invested in their public/crossover fund. We also invested in a separate organization, but with a shared legacy called Fraser Growth Buyout. And this is kind of the final fund to have a full relationship across the Fraser platform, as you will. This is Fraser's early stage fund. We're recommending commitment of up to $50 million. This would basically kind of complete for now our manager roster in biotech and life sciences. We're thrilled with the group of managers we've been able to develop relationships with, including Fraser, the Column Group, TCG Crossover, Bain Life Sciences, and Cure Ventures. While we always look for additional names, this is already a very strong list with a good balance between early stage and later stage / crossover investments. I'll pass it on to Richard for more discussion.
Thanks, Chris. Yeah, it was last June when we last talked about the Fraser Life Sciences Public Fund. So you have heard about this manager before and seen a presentation before. Really a strong manager in the life sciences investment space, focused on biotechnology and therapeutics. And as Chris mentioned, we're focused on the early stage venture capital fund today, where we're recommending an up to $50 million commitment. And this strategy really focuses on life science venture capital investments across a variety of stages and can make investments from the seed stage to public company investments. But they're particularly focused on therapeutics that address unmet medical needs. The strategy also has a focus on company creation, where the fund can get larger ownership stakes than it would targeting existing companies, which is somewhat unique. Post-investment as well, they're quite active with portfolio companies. They typically get a board seat to help assist management teams with improving companies. Fraser has just built a strong platform with more than 30 years of experience doing healthcare investing. This strategy is led by 3 partners, 2 managing partners who oversee both of the strategies, and 1 general partner who oversees just the private investing activities. And these 3 investment committee members have been with Fraser for an average of 20 years. The firm also has a dedicated network of industry executives, entrepreneurs in residence, and senior advisors that they can utilize across the investment process. The strategy's generated strong performance across many of the funds, including against public benchmarks and private benchmarks, where many of the funds have generated top quartile performance. So we're recommending a $50 million commitment to Fraser Life Sciences 12. And I'll turn the time over to the Fraser Life Science team for a short presentation, and then we're happy to answer any questions.
Thank you, Chris and Richard. Really appreciate the introduction today. As you mentioned, I'm here to provide some additional context on Fraser Life Sciences. So my name is Ailsa Dalgleish. I lead both the investor relations and fundraising efforts for Fraser Life Sciences, in addition to our marketing and strategy. We, as a firm, want to come together and speak to you about not only the firm itself, but also the products that we have available. So Fraser Life Sciences has had over 60 FDA approvals in drugs in the past since 2010, and we also focus on investing in companies that are developing transformative medicines, where we believe that they will be able to achieve a shift in the patient treatment paradigm. We have both a dedicated long-only public vehicle as well as a set of venture funds. To date, we have raised approximately 8 venture funds. We're starting in 2016. The last 4 were dedicated life sciences funds. The last fund we raised, Fund 11, we raised $987 million. We are therapeutic area and modality agnostic, which means that we will invest in any life sciences therapeutic that we think the area is of interest, and the technology that they are utilizing to address that area is also of interest. For Fraser Life Sciences 12, which is our upcoming fund, we envision this to be a 2025 vintage, and we'll be looking to raise approximately $1.3 billion in that fund. Like with our earlier venture funds, this fund will have a public sleeve allocation that has the potential to return early DPI. So for the Fund 12, that public sleeve allocation will be up to 15% of the fund. We'll be able to invest in public companies, and that cost basis will be recycled for the first 6 years of the fund's life cycle. The fund itself will invest across company creation, Series A, and other private investments, and we will plan to invest in approximately 16 core companies over a 3-year investment period. For each of those investments, we will plan to deploy somewhere between 50 to 80 million per company, and we'll do this utilizing multiple rounds and tranches per round. Within the greater Fraser team, you mentioned that we have both 2 managing partners, Patrick Heron and Jamie Topper, and they oversee Fraser Life Sciences as a whole, as well as our general partner, Dan Estes. And the 3 of them comprise the investment committee for our venture investments, and they're the individuals who lead on the venture side. However, when we go to make an investment, we actually have an entire deal team. This deal team is generally comprised of at least 1 partner, and then we'll have at least one of our 2 principals. It's either Anna Chen or Joe Cabral who will participate. And then we'll either have 1 to 2 of our junior members, as well as 1 to 2 senior advisors or operating professionals who have expertise in the deal area. These operating professionals are comprised of our venture partners and our entrepreneurs in residence. These individuals are extremely important to us because they help us source unique company opportunities, and they will also take meaningful leadership roles in our portfolio companies. By having our entrepreneurs in residence and utilizing our venture partners, these roles have really enabled us to scale our company creation. And we believe this is extremely important to our success and our strategy, as company creation, we believe, is an area of investment that can yield the greatest returns. Overall, when we're thinking about our investment approach, we generally have 5 pillars that we focus on. The first being, and this kind of separates us from other life sciences therapeutic companies or investment firms, is that we are very product focused. What this means is that we are looking to in-license assets or build out companies with assets where there's a very clear path through FDA approval. And not only are we looking to make sure that we think that we have a good sense of what FDA is going to be looking at in terms of endpoints and any of the potential challenges and obstacles that could come through that process, but we're also looking for, on the other side, that there is a really great unmet need for patients that we can address. And then finally, that there is the commercial potential, because coming into our second point, M&A is our primary exit strategy, and that is how we target liquidity. Since 2010, we've had over 34 M&As, and 75% of our realizations come from M&A. We believe that the past 3 years have actually been the best for mergers and acquisitions. And we can actually share in 2025, there's been over 18 billion M&As to date, with one of them actually being our own company or our own investment, Scorpion Therapeutics. When we are looking to do investments, we are very much looking for near value inflection points. This means that we're looking to in-license assets that are close to entering the clinic or would be close to driving clinical proof of concept. We are generally not looking for assets that are very early. For example, those that might be coming from academic institutions. Everyone at Fraser Life Sciences, including myself, we either have a PhD or an MD, and we believe very much in what academic institutions are producing, but we find that the research is just too early and it's not de-risked sufficiently for us to want to make that investment. Therefore, we're looking to kind of build up assets that are maybe 9 months away from the clinic and what we consider to be IND enabling studies. And those are the studies needed in order to go into the clinic and actually start to show success in patients. We're also looking for meaningful ownership in our companies. So for those companies that we create, we're looking to have over 40% of ownership. And then for syndications like Series A, Series B, et cetera, we're looking to have over 20% of our investment. We also want to be able to cut the largest check when we make an investment. This is because we lead a lot of the diligence and really roll up our sleeves. It's what we're known for. It's the reputation of the firm, that we look at that scientific integrity of the research, of the asset, and we are the ones who very much are leading the charge on whether we believe this is an investment worth having the undertaking. And when we do that, we want to make sure that we are able to cut the largest check and have the greatest meaningful value within that company. And both Chris and Richard alluded to us taking board seats, which is a very big part of this as well. We will take a board seat in every firm and generally will take an observer seat as well. And this enables us to help guide that company over time and really utilize that meaningful ownership and make sure that we're putting the dollars to work in the best possible way we can. And finally, something we're incredibly proud of is that we consistently work with our serial entrepreneurs. So I mentioned earlier that we have our senior advisors, entrepreneurs in residence, and also our venture partners. So our venture partners are individuals that we have been able to work with multiple times where they're able to enter into a company that they've identified. We build that company together and then they'll exit at key moments. So a great example of this is Maria Bardis. She is on her 3rd company with us, and she has actually had one of the most successful exits of Fraser Life Sciences to date, where in Fund 7, AstraZeneca acquired Acerta for over $7 billion. 4 billion of that was upfront payments. That was a fund returner for us. We have multiple individuals like this with very similar stories, and we're very proud to be able to work with them. And they keep coming back to us because we make it very much worth their while as well. So as I mentioned, company creation is one of our primary focus areas and comprises of about 30 to 40% of the investments that we will make. There are 4 primary approaches that we utilize in order to make these investments. The first is that we'll be spinning out opportunities from pharma. This means that we're able to look at pharma's pipeline, see deprioritized assets, and identify new angles on that research that we believe would make a great spin-out company and an opportunity to bring forward. Second to that are our biotech investments, where we will look at public or even public biotechs, and we will look to unlock the value of their pipeline for those that might be under financial pressure. One of my partners, Jamie Tupper, his favorite saying is that your lead asset eats the young, which means that for a lot of biotech, it's very challenging to bring forward an entire pipeline of products all the way to commercial. So once you get close to having a commercial product, generally speaking, all assets will all finances will funnel into that asset, meaning that the earlier pipeline are kind of left to be shelved. Or in our case, it's a wonderful opportunity for us to be able to out-license that asset and bring it forward ourselves. This is also a very good opportunity to highlight something that we talk about often, which are the synergies between our private funds and our public funds. So I know that Chris mentioned our public fund earlier. We have individuals, Albert Shaw and Jamie Brush and the rest of their team, who are constantly speaking with public biotechs and understanding what their pipeline is looking like. And through this process, we have the opportunity to get first look at what the pipeline spin out opportunities could be. And two very good examples of this are Iconis and Radionetics. So Iconis is a company that we spun out of the public company Ascendis. Very much through the relationship of our public team, we were able to see that this technology existed. It is overall, Ascendis is a company that is looking at increasing the half-life of drugs. So instead of having to take a drug, let's say on a weekly basis, they're able to extend the lifespan of that drug to be something that you take maybe every couple of months. Iconis is their ophthalmology portfolio. And so instead of having to have an eye injection on a weekly basis, which I can imagine no one wants, you have the opportunity through Iconis to actually receive this injection maybe every 6 months to a year, depending on your progression of your disease. Radionetics is another really great example of the synergies between the public and private, where again, the public fund was able to introduce us to Crinetics, public company, where they had the opportunity to, or we had the opportunity to out-license and build Radionetics. We were just able to announce that Lilly has undertaken 140 million non-dilutive equity into Radionetics, saying that they will acquire it for 1 billion in the next 3 years. Or if they do choose to acquire it for in the next 3 years, it will be a 1 billion payout. This has the opportunity to return at least half of that fund, that deal alone. Also, going back to the strategies, the 4 approaches of company creation, we will create companies de novo. This means instead of trying to in-license an asset, we will actually identify what we think is a very interesting target, maybe in an area where there hasn't been a lot of research in a therapeutic area. And we will then work with a contract research organization to identify the scientists and identify the team to build that actual asset. And we'll build it all the way from scratch through to acquisition. And then finally, our last way of doing company creation are utilizing ex-US opportunities. So the ability to in-license the technology from another country and build it up fully with American rights, and the ability to sell the product either through the US, the EU, kind of depends on a case-by-case basis, and we will have full rights to that company. And so all of this combined, the people, the approaches, the history, the reputation, has resulted in very consistent realizations for Fraser Life Sciences, including over 2 billion since 2020. And this is something the firm is incredibly proud of, in addition to over 60 FDA approvals since 2010, which means that if we're doing it right, we're seeing that progress, and we're seeing drugs actually making a difference in patient lives. So with that, I just wanted to say how much we appreciate your time and your consideration today. So thank you.
Thank you so much, and we will take council questions at this time. Hearing none, do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $50 million to Fraser Life Sciences 12 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate
I second. Kathy Allen.
The motion by member Bingaman, second by member Allen. Any discussion on the motion before the council? Hearing none, we will take a roll call vote on this motion.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
I believe the treasurer had to step away briefly for an important matter.
CFA Secretary Wayne Props,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes,
John Bingaman,
Yes.
Kelly O'Donnell.
Yes.
That's 6 in the affirmative, motion passes.
Thank you, and thank you for Fraser for being on with us today. Okay, next we'll move to agenda item 3F, 776 fund.
So we're recommending a commitment of up to $30 million in aggregate to two funds, 776 Fund 3 and 776 Adite, I think I said that right, Fund 2. 776 is a generous early stage firm founded in the last 5 years by Alexis Ohanian and Caitlin Holloway. And their idea is to establish a venture capital firm more in the mold of a technology company that deploys venture capital. The firm's based in Jupiter, Florida. Alexis Ohanian, you may have heard of him. He's an impressive background. He was the co-founder of social media platform Reddit, which is where he worked with Kate and Holloway, and they got to know each other. In addition to both founding and turning around Reddit, Alexis has been an early investor in a broad range of different sectors at the earliest stages. When he was the co-founder of Reddit, he was actually in the first cohort of Y Combinator, the famous startup accelerator. He was later a partner there on the investment team. He's a co-founder of a firm called Initialized Capital that had a great track record, which is on page 233. And he also, frankly, while he did co-found Reddit, he did completely turn it around later, which it's better to hear that story from him directly. And which is that company is now a $30 billion company. So excited to bring this one forward. Alexis has really proven to be a unique thinker and has made some very unique investments in things such as women's sports, the creator economy, and a wide variety of things such as Beastables, which is Mr. Beast's consumer product company. So I'll pass along to Richard for more detail.
Thanks, Chris. Yeah, 776 is a new venture capital relationship in the national program, and Fund 3 will focus on early stage venture capital investments, while the Arete 2 fund focuses on Series A and later investments as well. Just to reiterate what Chris was saying about Alexis's background, I mean, we really looked a lot at his background because, across the founding experience and the investing experience, he has more than 16 years of venture capital investing experience. And we were able to, because 776 is a somewhat new firm, we were able to look from a track record perspective at his prior track record before 776. And the funds that Initialized Capital have generated strong performance. He also has a very impressive angel investing track record as well. The 776 strategy will focus on a broad area within venture capital investing, which includes digital infrastructure software, but also other areas not as heavily trafficked by other venture capital firms, such as consumer products or women's sports, as Chris mentioned. The team does utilize their network to help source investments. And I think one of the differentiators for 776 has been developing an internal operating system called Cerebro, which is very impressive. We heard great things about it with the reference calls that we made. Cerebro does have basically a data and analytics platform that benefits both the 776 team and also the portfolio company management teams. I'm sure Alexis will probably hit on it more with his presentation. The firm has started investing both of these funds, and a question came up in the SIC meeting about any type of late charge for limited partners coming into later closes. The firm did confirm to us that there are no catch-up fees for limited partners coming in later. So I just wanted to clarify that with the council. So we're recommending an up to $30 million commitment, and I'll turn it over to Alexis for his presentation.
And we definitely want to hear the Reddit story.
Sure, how much? I was told I only have 3 to 5 minutes, but I'll do my best. Thank you. Thank you for that generous intro. Yeah, I was very fortunate graduating from college and getting accepted in the first batch of Y Combinator in 2005. That's where my co-founder and I started Reddit with a $12,000 check. We were in that same batch with the founders of Twitch, which would go on to sell to Amazon for $1 billion, and also Sam Altman, who would go on to join the Reddit board, and then obviously found OpenAI. But it was a special time, and after selling Reddit in 2006, after just 18 months for $10 million and, what was life-changing money for me, I stuck around for a few more years and then became a partner at Y Combinator. So early in the program, right in the midst of the housing crisis and the world sort of upending in 08, 09, I was on the other side of the table working with founders like Brian Chesky of Airbnb when they were going through the program, and really seeing at the foundational level with companies like Airbnb and Stripe what it takes to go on and build something truly transformational. And after a few years of doing that, I started my own venture firm. Initialized capital was in 2012, and grew that over the years. Got seduced to come back to Reddit in 2014 as executive chairman. That is where I met Caitlin, hired her as our head of people and ops in 2015. When I came back, to give you a sense of Reddit in 2014, it was a very beleaguered website, despite being 10 years old, almost 10 years old at that point. It was a forgotten part of Condé Nast, which was the company that bought us. It was doing 7 million, this is public, maybe 8 million in revenue that year, despite being 10 years old, and really languishing as a product, and had a pretty broken culture. Lots of things we needed to change, maybe 40 employees, and it was a real turnaround. And we're very fortunate to have amazing folks like Caitlin, and amazing investors to help us take the company independent. And so from 2014 to 2020, that's what I was focusing on and building. Then the company reached, billion-dollar valuations, and then I realized in summer of 2020 that I wanted to make venture really my life's work, and spend the rest of my years doing this, which is building 776. This is the last company I'm going to start. If you're curious, the name, it is the year of the first ancient Olympic Games, 776 BCE. My firstborn daughter is named Olympia, and I was going to name the firm after her as a bit of inspiration. My wife, Serena, wisely suggested that I don't do that in case we have another kid, so they don't get jealous. So I went with 776, so it's a nice little nod. Sure enough, we did have a second kid, so she was right. And this is what I'll spend the rest of my years doing. I even named my family foundation 776 as well. And another sign of the commitment, every bit of liquidity that I have gotten over the last few years, I've reinvested the vast majority of it after taxes into this fund. So right now, the GP is about 10% of our AUM, which is pretty unique. I've been told in venture, it's well over $100 million. So when I'm, investing in companies, when we're making commitments here, I'm very much thinking about my kids' future, as well as the partners, the institutional folks we have around the table. And then the part that I really love highlighting is, I've been lucky to be early, early and right in such a range of technology companies, from, Coinbase to Instacart to Patreon to Mr. Beast, to Cruise, which was a self-driving car company that General Motors bought, to even our latest investment, which is actually in this fund, which is Palmer Luckey's latest company. It's called Chromatic. The hardware is called Chromatic, but the company's called Mod Retro. And I think the reason why we've been so successful as generalists is because, one, creating Reddit, I am chronically online, for better or for worse, and I've built an entire career on a platform that, one, engineers love to use, so that helps us attract the very best talent, and two, gives me a pretty unique spidey sense on where trends are heading and where things are going, and for doing the job of early stage investing, it really was the best education. And then you combine that with a few years as a Y Combinator partner, and I really got a number of, having spent now over a decade doing institutional investing as a VC, first at Initialized and now 776. I can say this is the life's work. And I am a product builder first and foremost. Reddit was just the first thing that I designed. If you go to 776.com, we don't own the numbers yet, but if you go to it spelled out, you can see, real-time data that comes from our operating system that's on full display. These are the metrics of our firm and the support we provide for founders, and most importantly, the benefits they get out of the tools we've built that have helped them help themselves when it comes to requesting intros from our network, when it comes to generating press, when it comes to ghostwriting for our social media to help them get distribution. We're really building like a technology company. And after spending years building a venture fund, I realized we were the one industry that talks all the time about how software is, upending, innovating, revolutionizing industries. And yet venture shockingly doesn't really have many product builders building things for ourselves and taking advantage of how effective software is. So we try to be thought leaders in that regard. And the way you do that is you build a great product, which just reinforces the great brand with founders at the earliest stage. And then also I think the last note I'll make too is I tell my team this all the time, and every person at the firm, there's 13 of us right now, but everyone here is aligned. Everyone's getting carry or phantom carry, but everyone is getting carry. That was something that was really important. I think that's how we could build a $30 billion business in Reddit, that every admin to C-suite, felt like they had skin in the game. We're building our fund the same way. And one of the nice benefits of that is the culture it creates, the focus on execution, the focus on results, building software that helps us do the work better, cheaper, faster than our peers. All of that is aligned. And the thing I always mention to the team is that we're building this firm for DPI. And once you've had that first DPI check, it hits in a great way. And so this is also a firm that over time is not going to bloat into larger fund sizes. Early stage is our sweet spot. I think you saw a lot of firms get a little punchy during ZERP in terms of size, but for early stage venture, we know this is what we're aligned with. We want to drive towards those outsized returns, and that means we know where we can win. And 5 years in now, when we have sent a term sheet out, we get one back signed. And so we've not lost a term sheet head to head with, you name the top multi-stage, early stage firms. And we're rarely the highest valuation. And look, I've been doing this long enough that I know that won't last forever. And then maybe when the day finally comes that we lose on a term sheet, we're going to learn a lot from it. But for the time being, it's a sign that we're focused on the right things. We're building something the best founders in the world want to be a part of. And, like I said, I feel like even at 41, I feel like I have even more to prove than I did at 21 starting Reddit. And it's a blessing to be able to build this. And I know I said I was done, but the very last thing, we've also been very intentional, and you'll see it publicly online too with, we talk about it as values aligned LPs, because I anchored so much of this with my money, and the privilege of having the track record we have. We've really sought out, you name it, right? Pension funds, children's hospitals, cancer research, the folks that we're making money for were foundations. We're really proud to be doing so. And it's one that I think actually in the long term also becomes yet another advantage, because founders know we have this reputation. We walk the talk, and it makes everyone work even a little bit harder, because we know we're doing it for the right reasons, and taking care of some great institutions.
All right, questions from council?
Madam Chair, this is Nick.
Member Tejas.
Thanks, Alexis, for being with us today. I just had a question on the initialized fund 1, 2, 3, 4. And that initialized fund 1, you mentioned DPI, and that was 55.89 multiple. Can you comment a little bit on that, like how you were able to achieve that, and also the impressive IRRs for fund 1 through 4 in that initialized group?
At the end of the day, it's the power law. So we had a couple things going for us. One, the fund was just under $8 million. So we have to take that into consideration, right? Got to keep it 100. And then, being an early investor in Coinbase and then Instacart, really mostly Coinbase, but a little bit of Instacart was the end result there. And it's funny, I think about myself as an investor in 2012 when we started that fund, and I think about myself as an investor today, and I know how much better I am, and just simply even, there's still, gosh, there's so many things I would have done differently knowing than what I know now. But it really was, for me, a great lesson in, if you can attract top tier talent. And back then, frankly, it was mostly coming from the YC network, where obviously a lot of my like original deal flow came from over a decade ago, because that was, really one of one in Silicon Valley and in tech. But the nice thing is, a relationship like Brian Armstrong, I mean, this is someone who I seeded in 2012. I still text him. I've got text from him from like last week. And one of the subtle benefits of being, one of the earliest believers and, handing a check to someone or sending a wire to someone, before it seems obvious, right? Back when it seems crazy, like it did in 2012, is that as a founder CEO, and I know it, on the other side, starting Reddit, the folks who believed in me, those are the folks who I'm still quickest to pick up the phone for today. And you get this very interesting compounding effect doing early stage investing, where if you do right by founders, even the ones, statistically that half aren't going to work out, you still want to do right by them. But when you do right for the folks who are building the generational companies, and you went through that list, it keeps paying dividends, right? Because they still are a heat-seeking missile for talent. And so when their top employees go to leave, they say, oh, make sure you talk to Alexis about this new company you're starting. And it's probably the most satisfying part of this job, because you get to see the fruits of that for many, many years to come. And, we've gotten a lot better about portfolio construction. I think we had 100 companies in that very, very first fund. And like I said, it's been a great process of learning, continuously improving. And, funds 2, 3, 4, and again, these are like 2013, 14, maybe 15 and 17 vintages, are still going to be bearing fruit here, because we were, I was fortunate enough to be a lucky investor in companies like Flexport and Patreon and Row and Flock and Rippling, in those early days. So those funds have a little bit of DPI relative to Fund 1, but things are promising. But like I said, I still, for better or for worse, my wife married the kind of broken human who still feels like he has a lot to prove, and very, very motivated to keep going. And thankfully she knows a bit of that herself. So I'm really just trying to keep up with her legacy.
Great. Thank you for that. Thanks, Madam Chair.
Questions? Hearing no more questions, do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve the following commitments not to exceed $30 million to S776 Fund 3 LP and 776 Arete Fund 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second. Kathy?
Okay, we've got a proper motion by Member Bingaman, second by Member Allen. Any discussion on the motion before the council? Hearing none, let's take a roll call vote, please.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
7 in the affirmative. Motion passed.
Okay, and we thank the representatives from 776 for being on with us today.
Thank you very much for having me. And next time, happy to come by in person too. Sorry, look out for this trip.
Okay.
Right. Let's move on to agenda item 3G, Stellix.
So the final two investments this month are middle market buyout funds. Both firms are newer firms that basically were spin-outs from other organizations. So these folks had track records from prior firms and decided to create a new firm. In this case, Stellix is a group that focuses on underperforming, undervalued, or special situation middle market businesses in North America and a little bit in Europe. recommending $100 million to their third fund, Stellux Capital Partners 3. And in addition to that, we're recommending commitment of up to $50 million to a commingled side-by-side co-investment vehicle that will be managed by them on our behalf, that will not charge management fees or carry. The firm was set up in 2014 by Ray Whiteman and Michael Stewart. Prior to forming Stellux, they were the founding managing partners and co-heads of Carlyle Strategic Partners, which was at the time a similar strategy that the Carlyle Group had that was a little more upmarket. I'll pass it along to Amy to talk about it in more detail.
Great. Thank you, Chris, and good morning to everyone. Our report begins on page 288 of your materials. Stellux will be a new relationship for the SIC, and it will fit into the buyout category of the National Private Equity Program. Specifically within that, it's going to sit in the middle market buyout category. The firm, so it's been around for 10 years. It was started in 2014. But this team, the founders have really been doing this for 20 years since they were previously at Carlyle, where they launched a brand new platform, built a team from scratch, designed the strategy, and executed the strategy. So we really like to see that longevity of the track record of the co-founders. And the firm has a large team today. They're at 30 investment professionals. Mercer has watched this firm for many years now. They actually grew from 20 professionals when we looked back at our Fund 2 due diligence on them. So we've seen proper growth in the team, which we like to see. And we really like the strategy. It's very value orientated. They're seeking companies that have a lot of complexity that a lot of other private equity firms don't have the ability to purchase. The other reason we like this is typically they get in at very low multiples. So they're entering the companies at really attractive valuations. And then they're able to fix any of the operational issues that a company has. Alignment is average. New Mexico will be receiving a management fee discount based on the size of your commitment, so that's a positive. And performance has been good. Their first two funds are generating above median returns across the board, from net IRR, net TVPI, and net DPI. And they've also had some really strong exits to date. So we're recommending $100 million commitment to their main fund, Stellux Partners 3, and then $50 million to the co-investment vehicle. And I will turn over to Mike Stewart, who's one of the co-founders of Stellux, for their story.
Great. Thanks, Amy. And thank you all for giving me the opportunity to meet with you today. Without rehashing a lot of what Amy and Chris covered, my partner, Ray Whiteman, and I have been doing this together for quite a long time. It was a partnership that originally formed at the Carlyle Group, where, as Amy mentioned, literally started a strategy from nothing and built it into a really successful business at Carlyle, and really proud of what we accomplished there. And, like most people in life, about 10 years ago, we were thinking about the next challenge in life and what we wanted to do. And so given that we were largely on our own at Carlyle in terms of sourcing and identifying opportunities and creating value, felt like perhaps we could do this for ourselves. And the transition from Carlyle was great. We were well liked there. We were both partners at the firm, and the firm was incredibly gracious to us. They allowed us to use our track record for fundraising purposes, and even had some key folks there like David Rubenstein, Bill Conway, were early supporters of us as well. And so, we'll talk a little bit about the story today and the strategy, of course, but really proud of what we've been able to build as a firm over the last 10 years. In terms of the strategy, we are focused on the middle market. For us, that really revolves around companies that are anywhere from 100 to 500 million of revenues. They tend to be in older economy businesses, businesses that have been around for 100 years. They'll be around for another 100, where we can really focus on the core of our value creation strategy, which is really operational improvement. And as we get into Fund 3, which we're currently raising right now, targeting to write roughly $125 million checks into these companies, and plan on having roughly 20 portfolio companies as part of Fund 3. As was mentioned, we are a transatlantic strategy. The primary investment team is based here in New York. We also have a 7-person team in London implementing the very same strategy, and that was really a continuation of the geographic diversity that we deployed when we were at Carlyle. But very consistent deal thesis, approach to creating value. If you looked at our investment committee memos and stripped out where they were from, they would look virtually identical, and that's due to a lot of the work that Ray and I have done to ingrain the philosophy of the firm over across the pond. The other element that's really the secret sauce, and I'll talk a little bit in more depth later, is really our operator network. Most of the moves that we're making and the value that we're creating are frankly from taking businesses that are struggling, they're underperforming, they're undermanaged, they're desperately in need of some sort of a transformation. And over the years, ourselves as well as our team have built out a pretty deep and broad group of operators. Right now in the US, we have over 300 operators that we work with. In Europe, we have over 100. These are people that are active in the industries that we care about. And our job is to not only find good opportunities, but find opportunities where what's needed is the skill sets that these operators have. And I'll talk a little bit about how that process works. But it's been a really good model for us. Simply put, these are operators that we've made money with in the past. We've looked at a number of transactions with over the years. We're extremely comfortable with them. They know us. They know the type of work that needs to get done. They have the requisite energy and urgency to make change quickly. And it's really been, frankly, a pretty good mousetrap that we think that we've built to date. And as was mentioned, we're in the market for our third fund right now. Our first fund was an $870 million fund. Our second fund was a $1.8 billion fund. We're pretty much thoroughly invested out of that fund. And while we're still in the fundraising process, we have already closed on our first 2 deals in the third fund, and we have another transaction that's closing in a few weeks. So off to a really good start, and I'll talk a little bit later as to why we've been as active as we've been. In terms of the team, look, like most founder-owned firms, certainly early on, Ray and I drove a lot of what happened at the firm. But over the years, as Amy alluded to, we've really expanded the team quite a bit. Now we have approximately 50 team members. Again, most of those are in the US with some in Europe. And, we really spent a lot of time early on focused on developing this talent, really teaching them our approach to creating value, as well as, working on skill sets, how to hunt, how to fish for these opportunities, how to build your own operator networks. And couldn't be prouder of the investment professionals and the supporting team members that we've got. The other thing that's really core to the firm and to the team as we've built it out is diversity. We are a minority-owned firm. Approximately 50% of our team members are diverse, and 71% of our leadership is also diverse. And Ray, my partner, is African American. It's an ethos that I share with him, and it's been a real integral part of how we've built out the firm. And again, couldn't be any prouder about the group of individuals that we've got with us in the journey. In terms of drilling down on the strategy a little bit more, first off, while we are very opportunistic, I think the evolution of the strategy over time has really become much more industry focused. Again, these tend to be older economy businesses, and we've developed silos of industry expertise, primarily aerospace, defense, and government services. Probably not a surprise given our Carlyle background, transportation and logistics, manufacturing, real economy services, Food is a big area for us, as well as tech-enabled services. And again, drilling down into the operational efforts that we make, we're really focused on industries that are fairly steady and stable and predictable, because a lot of what we're doing is really making these businesses better. And so we tend to avoid industries that have potential for significant paradigm changes. So we're not into tech. We don't do healthcare. We don't do other industries that are in flux. And again, it allows us, as I like to say, it's a lot easier to hit a golf ball off of a tee than to try and hit a pitch that a baseball pitcher is throwing. We like to know that our industries are fairly predictable, so we can really, be able to just entirely focus on the blocking and tackling that's necessary to make for great organizations. Some of the differentiators for the strategy in the firm, one, because we are looking for underperforming and undermanaged businesses, typically there's not a lot of demand for these types of assets. Most private equity firms have a very different model. Theirs is based on financial leverage, which we don't use a lot of. They also tend to do more buy and build oriented strategies. They don't really necessarily want to roll up their sleeves, get in the trenches, and really, turn over these businesses and effectuate significant change. That's really up our alley, and probably about 70% of what we see from a deal flow perspective is either truly proprietary, there might not even be a banker involved, or there's situations where perhaps an investment bank has an asset that doesn't garner very much interest. They turn to us, and as Amy alluded to, because of the lack of competition for these businesses, we tend to pay very attractive prices, probably a turn or two turns cheaper than they otherwise would be. And the goal from our standpoint at a high level is to take businesses that are performing here when they really should be performing here, get them there, and because they become much better businesses, much better organizations in the process of us doing that, we tend to get multiple arbitrage as well at exit. So in terms of hunting for these opportunities, one of the differentiators is our sourcing. This is not a strategy where you're just waiting for emails on new deals. You have to get out on the field. In part of that effort, we've set up regional offices in Detroit and Pittsburgh because a lot of what we are doing are industrial manufacturing and service businesses. We like to fish where the fish are, and so we have local deal makers that are part of our efforts out there that help source many of our opportunities. I think one of the other areas where we differentiate is really in team experience. And not only do our folks have significant industry expertise and are generally considered well-regarded in these niches, but because the types of different transactions that we look at require a lot of different skill sets, they tend to just be uniquely skilled, being able to deal with both turnarounds as well as founder and family-owned businesses. It just requires a very different skill set mix than traditional private equity. And as I mentioned, we're very proud to have them. And then last but not least, I touched upon it, our operator network. Look, all firms have operators, but as I'll talk about in a couple of minutes, we tend to use them very differently. And as you might imagine, because these are underperforming and undermanaged businesses, our operator network doesn't just advise us or help us with diligence. They actually lead these companies. And our main emphasis is putting them into these businesses as early as possible. Again, these are people that we know are very talented. We've made money with them in the past, and we really want to get them engaged at the various earliest stages of our deals. In terms of the types of transactions within these industries we'll do, we do standard buyout transactions. These would typically be with founder and family-owned businesses. These are generally collaborations with the founders. They've built quality businesses, but they know there's a lot more that they can do with them. They just don't know how to do it. In a lot of cases, these businesses, because they're founder-owned, tend to have a lot of key man risk. The founder basically does everything from sell the product or service to actually delivering on it. There isn't usually a depth to the management team. There aren't systems and processes. It's not usually a data-rich environment. And they realize in order to get more value for their business, they need to have all these things. And so we typically will come in, make a control investment, allow that founder to continue on in a minority investment, and then we go about doing a lot of the transformation efforts, building out teams from our operator network that will take the business to the next level. And it's been a really good formula. In fact, most of our founders are actually great references for us as we go out soliciting these types of opportunities because they've seen not only the quantum improvement in their business and how they're positioned, but frankly, they just enjoy working with us. We're a relatively low ego, credible, engaging group that is able to develop good relationships with founders, and it's really a key asset as we explore those types of opportunities. We will do platforms, but generally they tend to be opportunities where there is an operational improvement story that goes with them. We will look after we implement that operational improvement for some tuck-in or add-on acquisitions, particularly in industries that are relatively unconsolidated and relatively free of other private equity investment. We will do carve-outs of spin-outs of businesses from parent companies. These tend to be a little bit more complicated to effectuate. A lot of private equity firms don't do them in general. We, in particular, tend to focus on things that are very challenging. As an example, at a high level, we've done a couple of transactions where manufacturing and distribution were co-located with the parent. And so in order to execute on the transaction, you had to set up an entirely new greenfield facility for manufacturing, build an inventory bank, keep the customers happy, pick up and move all of the equipment, get it reinstalled, get it re-up and running, and prove out that you can continue to make a quality product. Those are things that most financial investors just do not like to do. It is hard work, and because we're good at it, we're able to get very significant discounts because, again, there just are very few people that are able to do that. The other thing that I would say is that we will do turnarounds. And so about probably 20% of what we do is taking businesses that are losing money. And again, a very lift. We tend to get paid very attractively for doing that work. And in general, we're able to consistently, Fund 3 will be the 6th fund that we've had. We have been able to deploy capital relatively quickly. We've done a good job of returning capital quickly, and think given what's going on in the world, our strategy is particularly relevant. So with that, I open it up for any questions.
Madam Chair?
Madam Treasurer?
Hello, thank you for recognizing me. Thank you for your presentation, sir. I did have a couple of questions for you. The type of businesses that you work on that are underperforming, stressed or distressed, I did hear you say heavy manufacturing, food and distribution and services, aerospace and defense. Are there any other ones that are at the higher percentage of what you guys mostly work on?
For those, that's probably the most of them.
Okay, and then I'm just curious for my own personal knowledge. You mentioned your DEI, and they're pretty high percentages, and you've been around for a long time. Some folks that I've asked have said you just find the right good people, and it just comes out that way. Was it something that was more, it just came out that way because you found good people, or was there something that you did differently that made you have such high percentages?
Yeah, so it's a little bit of both. I mean, we'll always hire the best people, and it has worked out that way. We have made a specific effort through different diversity networks to bring in diverse talent. So there are a few organizations that work with folks that we can tap into. We also do on-campus recruiting at HBCUs as well. And like I said, it's been really helpful in building out a very diverse team.
That's really a beautiful story. With both you and Mr. Whitman owning 51% and 49 respectively, there was a suggestion that a succession plan should be in place with that type of ownership. So I wanted to just ask you what your thought process was on that, or what's your plan moving forward?
Yeah, we're actually a great question. We're actually in the process of doing that now. We've got a handful of folks that we think could potentially be next generation leadership. And let me preface it by saying that neither Ray or I are going anywhere anytime soon, but we're already working on that. We brought in some outside coaches and development firms that are actually working, doing some personal coaching for each of those folks. They've got action plans. Things that will help get them to the next level. And we've also been delegating some firm activities to them so that they get a little bit of a feel for what it's like from the firm perspective, not just the investing perspective.
Wonderful. Thank you, Madam Chair. I think that's really an important aspect, especially most of the time it takes at least a decade or two to try to get really to that point. So I'm glad you're being proactive about it. This is 40% larger than Fund 2, and I know this is, I think you said, the 6th fund you all have worked on. With the added 10 more investment professionals and more staffing that you mentioned, is this goal a realistic goal to get to the number that you're trying to get to?
Yeah, I believe so. I mean, one is the market environment. I mean, we will have closed, we're targeting 20 deals over a 5-year investment period. We will have closed on the first 3 deals over the course of 3 months. So we feel like we've got a good pace and think that market environment will continue. The other thing that we've benefited from is that as we've developed our professionals, we just have a lot more people now that are out hunting and sourcing and able to create value on these investments. And so certainly relative to the early days, we probably doubled or tripled the amount of people that are capable of doing that. And so I think the pace of investing will actually accelerate, frankly, due in large part to their growth.
Madam Chair, sir, I am very impressed with the way that you guys have managed your business throughout the course of different markets, different lifetimes of environments, and what you've been able to create seems to be very beautiful overall. So I definitely support this, and I thank you for being with us today. And I look forward to the partnership. I also, and this is something I do pretty regularly, I would like to put it in the back of your ear to make sure that you're thinking of New Mexico in ways that we can invest here in New Mexico directly with what you're doing with your programming. Thank you.
Absolutely. Thank you.
Further questions from council? Hearing none, do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $100 million to Stellex Capital Partners 3 LP and up to $50 million to a related co-investment vehicle, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second the motion, Madam.
Okay, we've got a proper motion by Member Bigman, a second by the Treasurer. Any discussion on the motion before the council? Hearing none, if we could take a roll call vote, please.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
Don Bingaman,
Yes.
and Kelly O'Donnell.
Yes.
That's 7 in the affirmative. Motion passes.
All right, thank you. And we thank Mr. Stewart for being on with us today. We're going to move now to the last of our investment voting items. I was going to just power right through that lunch break. I don't know if folks have other ideas, or I think as you need to maybe move away from your computer, but I think we should just probably keep going.
Madam Chair, I agree.
Okay. All right, Director Cassidy, agenda item 3H, Longhorn.
We're recommending commitment of up to $50 million to Longshore Capital Fund 2. It's a lower middle market buyout fund focused on business service companies in North America. This is a spin out effectively from a group called LaSalle Capital. So this is the heads of this firm have a trivial track record from their past investment activities. Occasionally we are going to do, despite the increase in AUM, we are going to target good lower middle market buyout funds. They have the potential to, given the dispersion of funds of this size, they have a potential to produce, upper quartile private equity and sometimes even venture-like returns, which is why we believe it makes sense to continue sourcing smaller commitments like this. It also provides a pipeline as these firms grow over the next decade. I'll pass it to Amy for her research.
Great, thank you. So our materials begin on page 335. Longshore Capital will be a new relationship for the national program. This will also be in the buyout category. And we really like it because it helps diversify your buyout segment because it is focused on that smaller end of the market. You see, even in the fund size, it's smaller. Like Chris said, that's really a focus for us, is to look at the buyout segment in totality, regardless of fund size, and really find the best opportunities. So we think that this is a good add to your buyout category. The firm was founded by partners Nick Christopher, Ryan Anthony. They have a history of working together for 17 years in a very similar strategy at LaSalle Capital Group. So we like to see that. This firm was founded in 2020, but the years of executing the strategy go way before that. So the firm was founded and the team has grown to include, they have the co-founders, a principal who also worked with the partners at LaSalle, so some good continuity in the team. And then they've also been growing their junior professionals as well as their operating partner network. The strategy we like, it's very focused on proactive sourcing. They're very focused on developing themes and then pursuing companies that really fit into their granular themes through different outreach activities. They're also usually the first institutional capital in a company. And so we like that they're the first ones in and really are driving value through 4 different things. They're focused on revenue initiatives, acquisitions, management upgrades, and productivity and performance enhancements. So Mercer, we spent a lot of time on their track record since this is a newer firm. We looked at both their track record at LaSalle, where they were previously, as well as the Longshore investments. And they had very strong performance in both track records, including realized returns. So we were able to verify that they have successfully managed investments from sourcing and investment through to the realizations. Terms are generally in line for where we see in the small buyout space. And so we're recommending up to a $50 million commitment. And I will now turn it over to the Longshore team for their presentation.
Thank you, Amy. Thank you, everyone, for the time today. I'm Nick Christopher, as Amy mentioned, one of the co-founders of Longshore. I brought my family out to New Mexico for vacation a couple of years ago. Was looking forward to making the trip back to Santa Fe and Taos, but we'll do it another time. Really appreciate your time today. As Amy mentioned, Ryan and I have been working together for a long time, going all the way back to 2006. We developed a strong working relationship and track record at our predecessor firm, LaSalle Capital, until we spun out and formed Longshore in 2020. We saw an opportunity in the market to port our track record, do what we were doing at LaSalle, but in a more profound, more robust, more aggressive way, and focus exclusively on tech-enabled services. We have thoughtfully built up our team over the past, almost 5 years now. There are 10 of us, and we are continuing to add to that as we get to a close in our second fund here. Fund 1 was $210 million. We've deployed that across 8 platform companies, have had a number of nice realizations. Fund 3 will be $325 million, and we'll invest that across 8 to 10 platform companies over the next, call it 3 to 5 years.
Hi, I'm Ryan Anthony, co-founder and partner here at Longshore. Thank you for having us, as Nick said, and maybe I'll just drill down a little bit further into the building blocks of a Longshore deal to give you an idea of how our strategy has evolved over the years. So as Amy mentioned, we look to invest in true lower middle market companies. So to us, that means sub $100 million in revenue, 3 to 15 million in EBITDA or cash flow. We're executing a control buyout strategy, looking at businesses in North America within the tech-enabled services space, and more specifically in 5 sub-segments that offer very highly visible and durable revenue streams. So we think of these types of businesses as mission critical to the services economy. They offer an all-weather feel, so don't generally cycle with economic shocks. And so feel those are good candidates for our strategy, where we go in, are the first institutional investors backing the founders and management teams to help them accelerate growth and improve enterprise value over our hold period. Our go-to-market is really centered around 3 areas. Number one, as Nick mentioned, we're sector specialists, so tech-enabled services only. That expertise and focus, supports our value creation efforts, and also, to Amy's point, allows us to go pitch that sector focus to founders, and also talk about our engagement model, the fact that we will be standing shoulder to shoulder with these management teams, helping them to build value over our hold period. And what that allows us to do is source in some pretty unique ways, where we're talking to founders over a period of years, building relationships, and then oftentimes partnering with them before they go through an auction process. After we've built up these businesses over a 3 to 5 year hold period, we've created something that is more institutional feeling, has a refined go-to-market approach, has a robust management team, has an acquisition strategy in place, and is really focused on building something that can sell upstream to a strategic buyer set or a larger private equity firm. So in essence, we help these companies grow and institutionalize within a sector-focused manner. So thank you for having us.
For being on with us. Mr. Anthony, are we opening it up for questions now?
Yes, please.
Okay.
Madam Chair.
Yes, Madam Treasurer.
Good morning. I wanted to start off with, when you mentioned acquisitions, what are the acquisitions of?
So referring to add-on acquisitions, generally, when we make an investment in a company, we look to expand their geographic reach or services set that they can sell into their customer base by doing small tuck-in acquisitions. Oftentimes, these are smaller competitors to the platform we're investing in that provide scale, management team depth, ancillary services that we can grow into. So it's a way to enhance value over our hold period.
Madam Chair, the documentation mentions revenue cycle management, tech-enabled BPO, payments, incentives, managed services, and human capital services. Can you tell me a little bit more in detail what each of those buckets is?
Yeah. So revenue cycle generally is helping hospitals and insurance companies manage their cash flow cycle. So we have third-party companies that we invest in that help accelerate that revenue cycle time and really kind of get cash in the door rather than having it sit on the balance sheet as accounts receivable for our clients. Tech-enabled BPO services, really is kind of the permanent, discrete, outsourced function that we do on a long-term basis for our clients. Could be, generally within kind of workflow management. You can think of adding software and processes and to create efficiencies and better outcomes, more accurate outcomes for our clients. Managed services, usually takes the form of an integration partner within a larger software ecosystem, whereby we are, kind of delivering a very complex software platform and helping manage that on behalf of our clients. Loyalty and incentives is working with companies on optimizing their customer base and creating that stickiness, within a consumer base to make sure they keep coming back. And then lastly, human capital services. You can think of that. I'll give you a couple of examples. We owned a security guard management business a number of years ago, and we have owned a company that manages the workforce at unloading services, at distribution warehouses, mostly in the food sector.
Madam Chair, thank you. That's a lot more helpful to put these in the correct buckets. So Longshore is new. It came around during COVID. You both worked at LaSalle. I'm curious as to some of the lessons you learned from working at LaSalle that are going to help you to do well and be successful with your new fund.
I think a big part of why we spun out is to bring some sector-focused efforts to the lower middle market. So Nick and I were effectively leading the tech-enabled services, business services silo within LaSalle Capital. LaSalle Capital was a generalist by nature, so invested in everything from food and beverage manufacturers to industrial companies, and we were really leading the tech-enabled services focused sector. We thought that by porting, as Nick said, our track record and that sector focus to a fund, we could accelerate what we were doing from a sourcing perspective and also a value creation perspective. The founders that we're partnering with love knowing that everyone in the firm has in-depth knowledge of their subsector and can thereby help with value creation efforts during our hold period. So that was really the main takeaway.
Thank you. Thank you, Madam Chair. No further questions.
Anyone else with questions? Hearing none, do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $50 million to Longshore Capital Fund 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second. Kathy Allen.
Got a proper motion by Member Bingaman, second by Member Allen. Any discussion on the motion before the council? Hearing none, if we could take a roll call vote, please.
Commissioner Stephanie Garcia Richard,
Yes?
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
Yes.
7 in the affirmative, motion passes.
Madam Chair,
Yes.
can I just make one comment to Amy and to also the SIC staff? This is the first time, if you look at the council's agenda, we have a lot of small deals. And I know it takes a lot of time, a lot of energy, and a lot of work for these smaller deals, but they're so important. I know this one wasn't one of them, but, or yes, it was. A lot of them are so critical to the diversification of the portfolio, and it's great that we can see these in front of us. So I just want to thank all of you for taking the time to do that and to start showing that shift within the portfolio and listening to the council members. So thank you so much for that. Really appreciate the shift.
Thank you.
All right, and we'd also like to thank Mr. Christopher and Mr. Anthony for being on with us from Longshore.
Thank you.
Thank you for
All
having
right.
us.
With that, we're going to turn it over to Director Dunn for items I and J.
Great, thank you. So I've got Ryan Eustace with me here as well from the staff. He's a strategist, but he's assisted me a lot on this project over the last year. We also got Matt Sturtevant with RBK, our consultant. So they'll be weighing in as we go through this presentation. Up front, I just wanted to reiterate what Member Bingaman touched on at the beginning. And that's, at the Investment Council meeting last week, as I presented the background on the structure study, the process around the RFP, the due diligence process, the portfolio construction process, and then the prospective portfolio. The investment committee reached the conclusion that it made more sense to treat this as a consent agenda item. So the primary focus of my presentation today will be on the process that we've gone through to get to this prospective portfolio. We do have the information on 4 of the new prospective investments in your materials, and we do have representatives from each of those investment managers. So as we get to that point, if there are specific questions or you want us to go more in-depth manager by manager, we're totally capable of doing that. With that being said, I'm going to start my presentation on page 380 of the materials. So this is the process flowchart that we referenced when we presented the structure study last spring. The structure study is what initiates this process that we're in the middle of. What we've been working on since then is the portfolio building and manager search due diligence process. So I'm going to walk you guys through that process today. That's what gets us to the manager selection portion, and then that's where council approval comes in, and with next steps being transitioning the portfolio to the new prospective portfolio. So next page, page 381, just a reminder of the purpose of ex-US public equity. It's to generate significant returns for the permanent funds, provide a high level of liquidity, and to provide exposure to economic growth outside of the U.S. We do have RBK's capital market assumptions in here. International equity is one of the asset classes that they expect over the long term to be one of the better performers, and that's why we maintain the exposure that we do at the SIC. So a reminder on the next page, the structure study recommendations. So the structure study was approved by the council last April. The overall recommendations highlights are to maintain the overall strategy, portfolio composition, and risk budgets. So that strategy was to deliver market-like returns. We have a goal of achieving 50 basis points of excess return on an annual basis. And when we talk about risk budget, it's those metrics like tracking error and beta. So tracking error between 0.75 and 1.5, and a beta of around 1. So you'll see the prospective portfolio maintains all of those overall kind of strategy characteristics. So one of the things we want to do, are recommending doing, is transitioning our passive investments from World ex-US to All Country World ex-US mandates. So what does that mean? So World ex-US, those are developed market only passive vehicles, and as you guys know, passive vehicles are index funds. So transitioning from a developed only passive vehicle to an All Country World ex-US. All Country World ex-US includes developed and emerging market geographies in that mandate. So part of the reason to do that is to bring that emerging market exposure into those mandates, as opposed to being in dedicated emerging market managers. So we're doing the same thing with our active investments in the large cap sleeve and the small cap sleeve. Some of the things that accomplishes for us is it expands the pool of applicants that we can look at. There's just more managers who run an ACWI ex-US strategy versus a developed only strategy. So we get more applicants to look at. It also takes the tactical weighting decision for our emerging markets exposure out of our hands and puts it into our managers' hands. So especially for our active managers, I think that's an important thing to note, as then we're getting real-time rebalancing of the portfolio in terms of our emerging market exposure based on where our active managers are finding attractive investment opportunities in emerging markets. And then overall, of course, we're still have a goal of maintaining market-like exposure. So you'll see later in this presentation, with this switch, our emerging market exposure doesn't change materially. Just the way we're accomplishing that is changing. We're expanding the mid-cap portfolio from one core passive strategy to also include active value, growth, and core strategies. This is an important one, and we'll touch on this later when we look at the rationale for having active investment strategies in the portfolio. But the current portfolio only has one core passive strategy in it, and active managers in the small cap space are one of the most fruitful areas for generating excess returns in the portfolio. And this portfolio did have active exposure to small cap managers in the past, and it was on its way to getting active exposure back in there. The active manager was terminated a few years ago, and so we're bringing that back into the portfolio, and we think that can really help our excess return prospects. We're recommending expanding the roster of large cap managers to reduce concentration risk and increase our tactical flexibility. This process is always also giving us an opportunity to identify replacements for managers who may have underperformed for extended periods or experienced significant changes to key personnel, or in most of the cases for the managers that we'll be recommending we terminate, they don't fit in the new portfolio structure. So again, we want to maintain broad international equity exposure with similar risk profile and outperformance goals to the current portfolio. And that was the structure study that was approved by the council last spring. So to get into the search and RFP process, our overriding objectives in this process, as we're selecting asset managers, we want to minimize non-investment risks. So when we're looking at ownership structure, we're looking at any legal issues, personnel turnover, SEC violations, things of that nature. We're looking to eliminate those as much as possible. Our objective is to evaluate the key drivers of value creation for each candidate and to understand whether the candidates are well positioned to replicate that performance in the future. And that leads to us to a general philosophy to focus on asset managers with clearly defined processes and philosophies that have been applied consistently over time. We do believe markets are largely efficient, but we also believe that strategy differentiation can add value. So 3 primary points of strategy differentiation that we're looking for as we're evaluating an asset manager: scale and stability of the resources deployed, a sound improvement investment philosophy and process, an ability and willingness to take risk. So when we're evaluating active managers, if we're paying active management fees, we want active exposure in that portfolio, and consistency of style and excess return pattern. So we're looking for managers that know who they are, whether they're a growth or a value manager. They have a real culture, a real process and philosophy around that, and they've been implementing that over a significant period of time in a really consistent way. So the first step in the search process is an RFP. We issued the RFP in June, and this is a very public process, so it gets posted on our website and broadly disseminated across the industry. Everyone has the opportunity to respond. We do set a few minimum qualifications in terms of assets under management for the managers and a track record of at least 5 years to submit. So these are, we purposely set these thresholds at relatively low levels because we really wanted to encourage a broad pool of applicants. So $500 million of assets under management for a large cap strategy and $200 million for mid cap with only a 5-year track record really gives a lot of asset managers the opportunity to respond, and that was what we wanted. We don't exclude asset managers from participating for any reason other than the meeting the minimum qualifications. and we don't solicit responses. So we want to eliminate any notion of preferential treatment. We want the selection process to be objective and merit-based. So we did get, on next slide, 385, we got 71 investment strategies that responded, so we did get a significant market response. So once we've received all those RFPs, and the due diligence process starts. So this is a 5-step process, really building on the same process that my predecessor followed in past manager searches, and follows the process that's also broadly outlined in our investment policy statement. So 5-step process. First step in the process is to evaluate the strategies for those minimum qualifications and style fit. As I mentioned before, we were looking for managers who were pursuing ACWI ex-US mandates versus developed market only mandates. Firm evaluation is step 2 in the process. So this is where we're looking for key personnel turnover. We're evaluating their ownership structure, their succession planning, legal proceedings, regulatory actions. And as we move through these steps, as you can imagine, we're gradually eliminating managers from this process. So, for example, in firm evaluation, there was one manager who submitted who was in the midst of a class action lawsuit, and they'd had 2 regulatory actions taken against them by the SEC. So that's a good example of a manager that we're going to eliminate from the process and how we gradually whittle it down. Step 3 is where we really get into evaluating the product, the team, the platform, and start to think about how it fits in our portfolio. So this is the point where we're really starting to engage with them via Zoom interviews with leadership and the investment teams. Step 4 is where we then conduct on-site due diligence. So we went and visited all of these managers in person, except for SeaWorldwide, because they're located in Denmark. So I was there in person for all of these. Ryan was at most of them. RVK was at several of them, and the ones they couldn't attend in person, they were present via Zoom. So part of our on-site due diligence process is to always have 2 members of staff present, and also have our consultant present. Go ahead,
Greg,
Matt.
if you don't mind, I just wanted to make a couple of comments on that slide, because this is going back months now from when this structure study was first approved back in May, I believe. And so since that time, there's been this aggressive evaluation process. And I wanted to comment on the widening of the funnel that Greg noted, meaning that we cast a wide net from the low minimum qualifications that, and by low, I just mean compared to other market participants, there was a willingness here to make sure that the barriers to entry were decreased so more firms could apply. And a couple of positives about that is it allows you to be very selective when you are trying to reduce that non-investment risk that Greg was noting, meaning that when you do encounter a manager or firm that has an issue that is observable and could be a conflict or cause a distraction, you have a lot of others to choose from. But the other part of this that Greg alluded to is the ability to increase the number of managers in your portfolio. And the rationale for that is the last time we did this type of search goes back a decade, to 2015. There's been a couple key evolutions. One is the size of your portfolio. Back then, international equity was roughly $3.5 billion. That's close to $9 billion now. And so a larger group of managers is necessary to reduce the amount of capital allocated to each manager compared to back then. And the other evolution that's beneficial is there's been an increased amount of the number of strategies that really consider the entire opportunity set, this ACWI ex-US, which just means developed and emerging markets countries. There's a lot more available now than there were back then. And there's historical reasons for how those universes formed over time.
but that's allowed for the search to take place and arrive at a group of candidates that we'll go through more fine points in evaluation, but that allow for a diversification of the portfolio and active risk in the portfolio without lowering the quality of the firm you're working with.
Thanks, Matt. Jump to slide 388 and just talk in a little more detail about that on-site due diligence, because I think that is the most important step in the process is when we meet with them in person. So it generally takes us 4 to 5 hours. We meet with everyone from firm leadership, CEO, portfolio manager, analysts, traders, operations personnel, and compliance personnel. And we cover, as you can imagine, a broad range of topics. So I've just got a list here of some of the things we cover, but just wanted to impress on you guys, how in-depth this process is, and how important it is for us to take the time to do that as we make these decisions. Slide 389, diversity, equity, inclusion is something that that the council asks about often, and we discussed it when we did the structure study as well. At that point, I told you that through the RFP process, we would collect diversity data from all the managers that submitted, or we would request it anyway. So we did that, and we did collect data from the majority of the managers who responded to the RFP. Some things I want to point out, I think first of all is to talk about our thought process when we think about diversity and how we think about it and how it factors into our decision-making process. So we consider it as a qualitative factor when we're evaluating firm culture. And I think especially for international managers, diversity of thought and diversity of background on the investment team can be a driver of success for them. When you think about they're investing in China, and they're investing in Latin America, and they're investing in Europe, and in India. So do they have, investors on their team who have backgrounds, not only investing in those areas, but insights into culture and business practices and, speaking the native languages there as well. So those are things that we're looking for, and that we see value in. So of course, our fiduciary duty is to select managers based on merit and portfolio fit. So diversity is one factor that's a part of that. Collecting the data, and I think asking for the data is an important thing to do. So for all of the managers in our prospective portfolio, we have that data, except for one, because they're based in Europe, so they're restricted from sharing that information for privacy concerns. So we have a baseline of data. We'll ask for updates to that as time goes on. And the prospective portfolio is a little more diverse than the existing portfolio. So of those 71 managers that responded, 5 of them meet the criteria of being majority owned by women or minorities. So looking at it at the ownership level, that seems to be the most common practice in the industry when we look at organizations like the NAIC, which is the National Association of Investment Companies, ICI, the Investment Company Institute, and some public institutions. That's how they define diversity. So we had 5 managers that met that criteria. We ended up recommending 3 of those, mostly because of that merit-based objective evaluation and portfolio fit. But we did view their diversity as a positive in that evaluation. And in the prospective portfolio, 53% of investment professionals are women and or minorities. And we want to continue to have active conversations with the managers in the portfolio, learn more about ways that they're working to promote diversity in the financial industry. and see how we can possibly partner with them or encourage them to do more as we learn more about what can be done. Portfolio construction on page 390. Again, the objectives of the portfolio, of the prospective portfolio are the same as the current portfolio. Risk profile stays the same. Big changes are the expansion of the roster, adding active management to this mid-cap portfolio, and transitioning from developed-only strategies to developed and emerging strategies, and moving away from dedicated emerging market managers. As Matt alluded to, the last time a major change to the plan was made, to the portfolio structure was made, was 2015, when it was a $3.3 billion portfolio. Today we're 8.8. I think that's probably already stale, and we're more than that. So the expansion of that roster is a key thing, which you'll see as I show you what the portfolio looks like in the next couple of slides. The active passive considerations, I alluded to this earlier. I think this is an important slide when we talk about our active versus passive exposure. So the prospective portfolio, we're moving to a slightly more active portfolio. We're on 391. So the active portion of the portfolio will be 75%. The passive piece will be 25%. The current portfolio is at 63% active with the remainder passive. So that increase in active is coming from the ACWI ex-US small cap space. So you can see in this chart at the bottom there, the long-term 3-year rolling excess return average for the top quartile ACWI ex-US small cap manager is 4.43%. And the median is 1.58%. So compared to the other asset classes, that is the asset class where you're most likely to achieve excess returns. Matt, this is an RVK graphic, so if you want to weigh in on this at all.
My only comment would be that it is net of fees. So we're looking at returns that are, where the fees are subtracted from the long-term rolling returns. But the other part of this is that small cap, mid cap part of the portfolio that's currently passive and had been historically active, that's going to be a key driver of this portfolio going forward for return, for excess return. And just overall, from the base, the portfolio is at now versus what it will be, this underlies the rationale to become more active at the margin within this space, which tends to be less efficient because of language barriers, just availability of data, and just overall volatility and cross-country considerations. So this underlies the rationale to become more active at the margin within this space.
Thanks, Matt. Page 392, I just wanted to make a few quick comments on fees. So as we get more active exposure in the portfolio, you pay higher fees for that active exposure versus passive exposure. But we were able to keep the fees at 31 basis points versus the current portfolio, which has an overall effective fee of 30 basis points. So we're able to increase that active exposure, but only increase our fees on the portfolio by 1 basis point. Part of the reason is our large cap manager average fee is, we've been able to reduce that from 43 basis points to 36. And how this compares to industry data, so median top quartile fees for a portfolio with the same allocation as our prospective portfolio would be 41 basis points. So we're pretty proud of the 31 basis points we were able to achieve. Portfolio construction on slide 393, you can see the current portfolio and the prospective portfolio side by side. So passive strategies, as we talked about, going from developed to all country ex-US strategies. or at least in the large cap space. We're already there in our small cap strategy, so that'll stay the same. There are a couple factor-based strategies in the portfolio, so those no longer fit the structure, so they will be leaving the portfolio. In the active large cap space, we had a couple of managers who've done a very good job for us and are all country ex-US strategies, so those are staying in the portfolio. We have a couple who are more focused on developed, so those no longer fit the strategy and will be leaving the portfolio. You can see the expansion of the roster there and the balanced mix of value growth and core managers in the portfolio. In the small cap space, we didn't have any active exposure. Now we'll have a sleeve of 6 managers, again balanced across value and growth. And our dedicated emerging market managers, that emerging market manager exposure will be achieved across our active and passive investments, as they are all ACWI ex-US mandates. So we no longer have a need for those dedicated emerging market managers. Next slide, 394. You can see what the portfolio looks like and the allocations. So in the large cap space, with the expansion of the roster from 10 strategies to 16, we're able to reduce our exposure to any one manager quite a bit. So our largest exposures in the current portfolio to some of our large cap managers are around 13-14%. But now our largest exposure to any large cap manager will be 7.5%, of course, excluding our passive vehicle. And then in the small cap space, we're allocating 2.5% per manager. That was important to, an important aspect of investing in a small cap manager is their liquidity constraints and capacity constraints that small cap managers have. Once a small cap manager kind of exceeds $2, $3, $4 billion in assets under management, it can really impact their ability to invest in the same way that they have, just because of liquidity constraints. So this 2.5% allocation per manager represents $225 million allocation to each of these managers. In the large cap space, that 7.5% represents $675 million allocation. So I think this is a good step in the right direction in terms of expanding the roster. Obviously, our pacing models indicate that we're going to be bigger as time goes on. So I think you can expect over the coming years that we'll gradually layer in a bit more expansion to the roster as time goes on, so we're not overwhelming our managers with assets. And then just a few more slides for portfolio construction, just to show that with the changes to the portfolio, that we're still delivering market-like exposures and market-like returns. One thing I forgot to mention on the previous slide. So tracking error for the prospective portfolio, 1.3, so it's within that target range that we have. The beta, 1.02, also right around that range of a target beta of around 1. So in terms of what the portfolio looks like from a country allocation comparison, you can see that our exposures aren't changing a ton. We're still pretty close to the benchmark. Another way we look at it is sector allocation. And again, you can see some moving parts, but the prospective portfolio, the current portfolio, and the benchmark have pretty similar sector allocations. And in terms of weighted average market cap on slide 397, so we have a little bit of a reduced size profile because we're adding that active exposure in the small cap space. So we're going from a portfolio that, in terms of weighted average market cap, a little bit bigger than the benchmark, to a weighted average market cap that's a little bit smaller than the benchmark. But I think those are all the main points I wanted to hit. The next steps in our process are, getting council approval, obviously. Then we will engage with the SIC approved transition managers. So it's been a while in the public equity space since a transition has happened. So just a reminder that the council on, I believe it's a 5-year rolling basis, approves transition managers. So we have 2 transition managers who are council approved that we'll be engaging with and getting essentially bids from to transition the portfolio from the current structure to the prospective. And we'll bring that to the council as we get that. And then our goal is to transition to the approved structure on July 1st, which is the beginning of our next fiscal year. So with that, I'd like to open it up for any questions around the process, and then we can move into discussion of the individual managers at whatever level you guys would prefer.
Madam Chair?
Prepared. I think we should probably just at this time take questions, and if the prospective managers can be open to questions at this time as well. So, Madam Treasurer.
So I want to thank Mr. Dunn for such a very clear presentation on exactly what we went over and even in more detail of what their process was. I think as an observance of what a good process looks like, which you sometimes don't see in many different agencies or governments, this was a really good process. The timeliness of when we approved to today, going through 71 managers, opening up the doors to allow for more people to participate in the process, but still having enough guidelines to not have anyone participate that didn't meet those qualifications, having the due diligence, making sure there's 2 staff and the consultant there. That safeguards SIC. It protects our staff, and it lets people see different perspectives from what they see during the due diligence. The termination of people who are not pulling their weight, and it coming back before the council for us to be aware, and the discussion and detail and thoughtfulness of incorporating while still keeping our fiduciary responsibilities of talking about diversity within the funds allows for us to grow that vision and mission that we just approved. I didn't remember everything else that he talked about off the top, but that's probably one of the better presentations I've ever heard, Mr. Dunn, when you're talking about a process of what was done and the thoughtfulness behind it. I'm very grateful for all the work that went into it and for you guys pushing the initiative that the SIC had approved last year. I know that doesn't get into the details of the fund managers. I don't know if we'll be asking you any questions, but I do want you all to know that a partnership with SIC is a professional partnership that we're looking forward to working with all of you. I would just know on my end, as one of the elected officials on the council, I'm always looking at ways we can partner on the investment side with New Mexico or having students intern with you or working with you. I think all of that is just as important. And if you're not quite there with diversity, equity, and inclusion, being that New Mexico is a majority minority, I'm hoping that you're doing things that will help strive to get you there, because that helps mitigate risk and encourage better rate of return. Thank you. Thank you, Madam Chair.
Thank you, Madam Treasurer. And, it's my proposal is that we do all of our discussion and question in this agenda item, because we are going to do a consent vote in the next agenda item. So if you have questions for the potential managers or the proposed managers, please ask them now.
Madam Chair, I have a question for Director Dunn and perhaps for our Chief Investment Officer.
Member Bingaman.
Just, we've consistently been underallocated to public equity international, and, recognize you've been going through this process. Is it your expectation that kind of once we get through this process, and assuming all of these managers are approved and we go through that transition, that we'll be kind of moving up much closer to our long-term target in terms of the asset allocate, the 20% allocation target?
We've been within rebalancing range of our long-term. Outside of those, we're slightly below, but so our rebalancing bands are 5 percentage points around each one. I think we're like maybe 150 basis points below on both international and domestic. So we're pretty much at the long-term targets. Now, part of the package, that we'll be bringing you on, this spring, part of the macro package, part of that will be, a discussion around, do you want to temporarily raise our equity exposure, publicly traded, with, you know, keeping in mind, maybe we still want these long-term targets, but we can.
Sorry for interrupting, but can you speak louder?
Oh, I'm sorry.
Yeah, so part of the discussion will be, do you want to raise, on a temporary basis or an interim basis, do you want to raise our publicly traded equity to get money out of cash and bonds? That'll be one of the options, part of the options we'll talk about this spring. But we've been within the rebalancing bands of our long-term targets in all funds, for quite some time.
Okay, understood, but I mean, within the rebalancing bands, it does remain true that we've been kind of right around a 17% allocation relative to a long-term target of 20%.
Yeah.
For the international.
Yeah, I
We've
think
been
we're
very consistently underallocated.
Yeah, I think we're closer to 18.5 now.
Okay.
It could be slightly less than that in international, because those markets just haven't performed as well.
Okay.
And we've added a little bit, particularly to the funds that got big inflows. We added Land Severance, ECE, all had equity purchases here in the last few months.
Okay. So that the relative allocation to this asset class hasn't been impacted too much by this process or waiting for this process to conclude, in other words?
No, not at all.
Okay.
Not at all.
Understood. Thanks.
Madam Chair, did any of the managers have anything to state based on what they've heard us speak about today? Because during consent, we won't be able to hear from you.
And I'd encourage you only to speak if you need to, if something wasn't covered. All right, if there are no further questions, let's move to the next agenda item. We're going to take all of these managers as a consent vote. So that's Brandy's, Hardman Johnston, C Worldwide, and Cedar Street. Do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor RBK, and SIC staff, I move that the State Investment Council approve commitments to the following ex-U.S. public equity managers: Brandy's International Equity, Hardman Johnston International Equity, C Worldwide International Equities, Cedar Street International Small Cap Value. Per the recommendation of the CIC, the selections here are part of a slate of managers be approved via consent agenda this month and next under terms discussed and memorialized today, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second.
We've got a proper motion and 2 seconds, a second and a third. Motion by Chair Bingaman and a second by Member Allen and the Treasurer. Any discussion on the motion? We could take a roll call vote, please.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
and Kelly O'Donnell.
Yes.
6 in the affirmative, motion passes.
We thank the managers for being on with us, and I would just like to echo the Treasurer's thanks to Director Dunn and his team for what seemed to be a thorough process.
Thank you.
All right, with that, we're going to move into agenda item 3K and hear from Mr. Smith on portfolio liquidity management.
Well, thanks, Madam Chair, and I'll get you finished here in 3 or 4 minutes, will be all it'll take. So we've had some questions in the past about cash holdings and liquidity management, and some thoughts that do we hold cash back against, future capital calls and things. So I thought I'd just put up a couple slides. Go ahead and go to the first one there, Brent.
Yeah, so this is just you've read this is just a description of the different types of liquidity that we have. Every fund like us has those same sort of types of liquidity. So why don't you skip to the next one, Brent? And one more. Yeah, okay, so this page just shows you the uses that we have of that liquidity. So operational cash flow, which is just, distributions and expenses.
What page are we on for those who can't see the screen?
This is 544.
Can you share it on the screen?
Sure. If we go to zero left. Yeah, there you go.
On the workplace part?
Here. Yeah, click on there.
Thank you.
There we go. Can everyone see that one? Looks like they can.
Should be.
Okay.
Yes.
Yes, sir.
Yeah, so out of these, for most funds, and particularly for us with the big inflows we have and the sort of the excess capital we've got sitting in cash and bonds, the most important sort of use of liquidity is when we have a bad market event. So think 2008 or 2000, even in 2020 and COVID when markets were down about 35%. Lots of times in history, we'll get more than a 20% drawdown. That's the really important use of liquidity, is being able to rebalance back into those risk assets, primarily stocks, and we've got some REITs and a few MLPs that we would rebalance into. They would be down at the same time. So that's probably the most important thing, and we've done 3 different liquidity studies over the years to kind of talk about that. Like here would be a common drawdown if we had stocks down 35%. Here's what would happen across the portfolio. Here's the amount of liquidity we would need to fully rebalance, and maybe a little extra to take advantage of other opportunities that popped up during a crisis. So we've kind of briefed you 3 different times on that, including the potential use of leverage. We'll probably come back maybe next fall or something with Liquidity 4.0 and talk about it again if you make any decisions this spring on changes to how we manage this excess liquidity. But that's the most important part, is being able in a stressful market to be able to respond, have the liquidity to respond. Go ahead, Brent. And one more. Okay, so this is 546, and it's just a graphic for you. You can see in the middle where there's the uses of liquidity and some of those things we were just talking about, including market dislocation opportunities, and then sort of the sources of liquidity we have, the natural portfolio sources of inflows and things, and then of course we can always sell publicly traded market securities. That's sort of a last resort. I've seen a few funds get in trouble, particularly back in the 2000s when funds were using alpha overlays on their domestic equity portfolio. So they literally were getting their exposure in the futures markets and using the cash to give to hedge fund managers to generate alpha. And then, of course, 2002 came. Markets went down. They started getting margin calls on their futures exposures and couldn't get the cash back from the hedge fund managers, and just absolutely got in a big mess. So selling securities is something that's hard to rely on when you get in those type of markets. Next slide, Brent. Oh, that's the last. Oh, that was the last one. So really the main comment is, we look monthly at what our liquidity levels are. So how much do we have in cash? How much do we have in treasuries, which is a very easy thing to sell if we need. How much income came in that month? What were the distributions that month? Capital calls. We take a snapshot of all that, and the accounting department provides me
provides me a sheet that shows how much liquidity we have in each of the private pools, how much cash is on balance sheets. I can look and see what our treasury bond holdings are, because we just have a couple of treasury accounts. That's our sum of our, or the total sum of our available liquidity. And then we've got a gigantic spreadsheet. If anybody wants to see it outside the building, tell Charlie and we'll get it to you. But it's a gigantic spreadsheet where we pull in for each of the 12 funds, where we pull in the current value of all their holdings. We make some market value adjustments. We run it through our long-term allocations, our interim allocations, any tilts we might have on just due to market factors. And on the very right-hand column of the sheet, it tells us what we need to trade for each fund to get it exactly to its target. Now, we never do that, of course. Some of the private markets where we can't put money in. Others are maybe small trades where, just the cost of making trades seems like it would be excessive. Certainly it shows us if we're inside of the rebalancing bands. So to answer some of the questions we've had in the past, we don't really set aside liquidity for any particular thing. We've got a pretty good view the next few months about what liquidity requirements will be. We've got a longer term view with our pacing model on what capital calls and things will be. Longer term view, both a short term and a long term view of what distributions will be from each of the funds. So we've got a pretty good view out, whether it's a month or two in terms of potential capital calls and distributions, or it's a year or 2 or 3 down the road, inclusive of capital calls that'll be coming in during that time frame. We've got a pretty good view of what our liquidity requirements are, and monthly then we analyze what we have in liquidity against those things. So we just wanted to throw that up for you and see if there's any discussion you wanted to have around it. But it's a pretty simple process, and we have good view of both sides, both the liquidity that we have and the liquidity that we'll need.
Questions from council? We thank you for the presentation. Let's move on to our governance matters, agenda item 4, and we'll turn it over to our governance chair, Member Allen.
Thank you, Madam Chair. And just to kind of refresh what this committee is looking at is right now, first and foremost, pay bands and we all agreed at the offsite that we're supporting the idea of getting better pay for the staff and also new hires in light of the growth of the funds. So that's part of what we look at. We also look at good business or best practices in governance, including ethics. We look at public awareness, and we had Charlie put out a very nice press release a couple of weeks ago about what we're doing with New Mexico investments. And then we also look at candidates for to be added to the SIC. And I've been working with the State Investment Officer. We still have one vacancy. We've gone to the governor with a number of recommendations and quite a few times, and no answer yet. And it's likely we won't have someone this session because they don't have it on the agenda. So anyway, unless we get lucky, what we have to do, it's really important to pay attention to attendance at meetings just to have a quorum, because we're really tight on that. In the looking at staff pay, we have had 3 meetings in January with the committee, and we also have invited Wayne Probst to join the committee, or at least those discussions. We've heard from consultants, we've looked at the research, we've looked at comparisons with other funds, and we continue to have discussions right now on the pay bands. We're hoping we will have another meeting. We'll have some discussion today, another meeting to finalize that, and hopefully to be able to bring that back to you for the February SIC for discussion and vote by the SIC. And I'm going to turn over to our State Investment Officer to talk about the pay bands and give you some of the justification of what we're doing in developing these.
Thank you so much, Kathy. And so we're kind of wrapping 4A and 4B together, and we're not going to go over individual recommended pay bands today because the governance committee, as Chair Allen mentioned, is going to go back and do some additional work on them. Hopefully we can come next month with a recommendation. But in putting together these draft pay bands, we're taking a look at the McLaughlin data by position. The data that Dr. Monk's Ascension team put together was really helpful in the aggregate, but it didn't dial into position-specific information for most of the positions. So we're really taking a look at the McLaughlin data. And as McLaughlin mentioned in the presentation at the retreat, they said that because public funds often struggle recruiting, because there's no really existing industry for these professionals in New Mexico, and because Santa Fe has a 14% higher cost of living, they recommended that we target something between the 50th and 75th percentiles. That was in relative alignment with Ascension's proposal that we either go with their peer group comparison or go with something approaching McLaughlin 75th percentile. Their peer group comparison would have had us just slightly higher than the McLaughlin 75th percentile. So I'm working with the members of the governance committee and really want to thank them for all of the work that they're putting in going through all of this with me. So really huge thanks to them and to all the members for recognizing the incredible staffing need that we have because of the remarkable rise in assets under management and the projected rises that we're going to continue to face over the coming years, and that we need more people to be able to effectively get this money invested and to manage it on the back end. So with that, I'll be prepared to give a lot more detailed comments when we come together into the next SIC meeting with a full, complete recommendation from the governance committee. But again, just we really want to thank the members for putting in a lot of time and effort in working on this with me. So thank you so much.
Mr. Clark and Member Allen, I had a couple of things that I would like the governance committee to consider when they're putting together their recommendation.
Okay, taking notes.
So the first was the option of perhaps proposing, instead of an across-the-board reclass, just targeting those positions that I heard from you, Mr. Clark, are either hard to recruit, hard to staff. I don't understand why we're doing an across the board when some folks don't seem to necessarily need. I don't know if that's going to cause compaction. I know some folks are at the very top of their pay band already. Those make perfect sense for a reclass. But that's my first question is can we do piecemeal, just targeting those particular positions that you have concerns about versus a full across the board new pay band?
I'll take a first crack at that. We're actually looking at every single position because some people have been underpaid for some time. It is also, we want to understand the comparative pay bands. And so in some cases, people may not change, but in others they will. I think I think from the committee's point of view, we wanted to look at it in totality rather than just cherry picking.
Okay, and then I guess that leads into, oh, I'm sorry, Mr. Clark?
Oh, sorry, yeah, Madam Chair, I was just going to say I liked the comment that Chair Allen made about wanting to take a look at it in totality, and that we do face issues with trying to get qualified people into some of these positions really across the board, and it was, I think McLaughlin and Ascension identified that there are a whole host of positions where we are not paying competitively. It's not a few isolated items. And so if we went in and addressed all of the ones that really needed to be addressed and didn't address a few that maybe weren't as necessary. I feel like the people who are currently in those few positions might feel very slighted that they somehow were selected as not being included in part of this otherwise total revision. And so I think it's probably necessary to take a comprehensive look. Again, most of these pay bands were not set up with our organization or organizations like ours in mind. They certainly were not set up with the thought that we would be overseeing $60 billion. And I think it's worth taking a look from the ground up at what should they be, especially now that we have a pretty complete set of comparative pay data from McLaughlin.
And I'm going to just add into that, which is, I think what we're creating is a base for going forward, so that we will, every single employee and or position will be fairly paid and competitively paid, and we go forward from that.
The only comment I would make in response is it depends on where those particular positions fall within the new pay band classifications. You know, if it seems like they're not fairly compensated in comparison with their peers, then absolutely. But I just think an overhaul, a complete overhaul, I would just, I'm questioning whether that's necessary, I guess. I still question that. My second question is, so John, when you came and presented this to me, you said that we were targeting the 75th percentile, and I'm wondering why we have to either target the 50th percentile or the 75th percentile of the recommendations. What, is there not a number between those we could target?
So Madam Chair, what I meant to say was, I want the top end of the pay band to include the McLaughlin 75th percentile. Not that we're targeting that as a specific pay level for specific individuals or across the board, but the intent was that the very top end of the pay band be set at least to that McLaughlin 75th percentile. In talking with McLaughlin about positions that are particularly hard for public funds to recruit, there are a few positions where I'm recommending that the top end go a little bit higher, or where the McLaughlin data doesn't appropriately capture what the position does, and our relevant position is more comprehensive and has more responsibilities. My plan is to go into the next discussion with this, where we go through the actual pay bands with both a variety of broad justification points for the plan in general, but then also specific justification points for every single pay band, so that you can see clearly what my reasoning was and what the reasoning of the governance committee, through whatever changes they make to my initial draft, are for how the pay bands are set how they are. And just to make it also clear, one thing that we're attempting to do is to create career ladders. For the vast majority of the positions here, there is no career ladder possibility. Those pay bands do not exist. And we want to be able to keep people here. If they're doing a great job, if they're committed to being here, but they don't see any way to move up, then inevitably they're going to be looking for other opportunities over time. And so part of what we're attempting to do is to create career ladders so that we can keep people here over time.
A special call out to our Madam Treasurer, who she and her staff have really done a lot of work at looking at specific pay bands and what the justification is.
And so every single position will be recommended at 75th percentile?
Madam Chair, no. So each position is being considered individually, and without the governance committee having taken a final vote, we don't know exactly what those final numbers are going to look like. But my intent going in was that, again, the very top end of the pay band at least cover that 75th percentile, again, based on the recommendation from McLaughlin and from Ascension that we make that a possibility. So for example, if we have the opportunity to recruit an extremely experienced professional from another state where we have to go to that 75%, I would like to be able to do that. I would also like the members of our team who are currently here to be able to see that over time, that is something that they could grow to. If they spend 20 years with us and are doing an amazing job, I want them to see that that is a possibility over time.
I can respect that for sure. My final sort of, I guess it's a word of caution, really. I have a lot of heartburn about that position at the very top of the pay scale, that with the 75th percentile of the recommendations would receive a 40% increase, making that salary almost 11 times the per capita average salary of the average New Mexican. This is a public institution. You know, if there's private companies in New Mexico that pay that much, so be it. But I don't know of any public official in New Mexico that makes even near that much. And that many times the average New Mexican salary. So I have a lot of heartburn on that one. I have a lot of pause on that one, and I would just really caution you all about what you're putting forth.
Madam Chair, we really appreciate the feedback, and we will take that into account. Again, I just want to caution anyone looking at these to realize that the intent is not to immediately move everyone up to 75th percentile, and with the case that you mentioned, you know, give this person a 40% pay increase. That's not the goal. The goal here was to set the very top end of the pay band equal to the 75th percentile. There are also government officials in New Mexico that do make more than that. We have university presidents, we have people who run sports teams for our universities who make more than that. And I guess I would say, I think while I am not advocating for salaries at that level, I think overseeing a $60 billion fund for the state is at least as important as running any of our universities or overseeing a sports team.
Appreciate you hearing my concerns. Anyone else? As a reminder, we are not voting on this item today.
Right.
Madam Chair, this is John Bingman. I just wanted to make one comment.
Yep.
Just wanted to point out for members who weren't able to attend the offsite, and just comment in support of trying to incorporate that 75th percentile from the McLaughlin data. What we heard from the other consultant was that the McLaughlin data, I think, includes a number of smaller pension funds that really don't look like we do today, and certainly not like we expect to look in just a few very short years in terms of scale and sophistication of our asset allocation. So I just wanted to point that out.
Thank you. Anything further on this item? All right, let's move on to agenda item 5 and hear from our CFO.
Madam Chair, I will be very brief. Just a couple of things to point out. As I normally do every month, you have a budget to actual comparison. The one provided is for the period ending December 31st, so that's 6 months into the fiscal year. I'm not anticipating anything happening where we're going to be short on the budget through the end of the year, so I think we're pretty good there. I did want to point out on the investment holdings report, this is a report that ends on a quarter end. So it's over 80 pages long, which is fairly extensive. The reason it's expanded at a quarter end is not only are we showing a monthly roll forward of activity, but we're also showing a quarterly roll forward of activity by fund, by manager, by pool. You have it all within the reports, and I'm happy to answer any questions that anybody has. I did want to point out on agreed upon procedures, we're in the process of having samples pulled for the period ending September and December. As you might recall, we're a little bit delayed in getting these agreed upon procedure reports completed due to conflicts that we have with the completion of the audit. But they're in the process of pulling samples right now. I think an engagement letter for the agreed upon procedures is on John's desk, so they're in the process of starting that. I did want to point out, and this is just for informational purposes, that the Office of the State Auditor did notify our audit firm, Moss Adams, that they wanted to review the work papers for the agreed upon procedures report ending June 30th. So we're waiting for them to complete those procedures. I think we've signed a release for Moss Adams to be able to release any work papers related to that work. And then lastly, I just wanted to point out on page 641, and I'm not going to go into any detail, actually go forward one page. I have included the audit report for the fiscal year-end June 30th. We have been authorized to release this report. I did want to point out, as related to the report, it's an unqualified opinion. There were no findings by the auditors, no adjustments by the auditors, with the following caveat: as is the case on every audit here that I've ever been involved with, the adjustments that occur at the end of the year are just related to catching up the 90-day lag in the valuations of our private assets. Other than those adjustments, there were no other adjustments that the auditors had to make, and those were actually provided by my staff. And then I was kind of hoping to bring them in this time, but I wasn't able to do it because we were a little compact in here today. I did want to give special thanks to the investment accounting manager, to Riggs. This is the first year that she was actually in charge of the audit process on the investment side, so I really appreciate her. Also, Andrea Cohen, Norma Parra, Steve Benioff, my assistant, Rita, the person at the front desk, Catherine. I really appreciate them, and at some point in time, I'd like the council to be able to meet all of them, and hopefully I'll be able to do that in a future meeting. And then lastly, on page 731, I think there was a request sometime or approval of getting a listing of quarterly contracts greater than $250,000. I've coordinated this with Amy. These are the contracts that were entered into during the last quarter of the fiscal year end, and not the fiscal year end, the calendar year end, and I'm happy to answer any questions on that. Don't really have any comments, and I'm open to any questions anybody might have. I didn't go through the audit report in detail, but if you get back and have questions that you want to ask, just give me a call. I'm happy to answer anything offline that you might have. That's my report, and open to any questions you might have.
Thank you, Brent. Questions?
Sure. Just one question on the risk analysis, and I know we have a separate group that looks at risk. Do you look at that once a year when you get the audit? Do the auditors look at what we put as our risk assessment?
Are you talking related to IT?
Any kind of risk. It could be cybersecurity risk, geopolitical risk. What I'm saying is, when we use Moss Adams at the Museum Foundation, and when we do our 990 and our audit report, we also use that as a time to discuss in general with the board the risk report. And so a question is when will we discuss the risk report, and do we do it at the same time as the audit? And Musk Allen looks at our risk report, Musk Adams looks at our risk report and opines on it.
Yes, I can only say, Kathy, I would say it's probably at least every year. We do have quarterly audit committee meetings, and there's a kind of a checklist of things that they go through, and that's gonna happen on an ongoing quarterly basis. To my knowledge, there hasn't been anything that's popped up on that. As far as like penetration testing, I know probably several months ago, we had an update to a pen test, and I don't think there was anything there. And we continue to kind of monitor that. Probably the biggest concern that we have is just on the IT side. Anytime you have systems like our systems or systems in general, you have people trying to get in there. We're very mindful of that, and we'll continue assessing the situations as they might arise. But if you have any input you want to share, I'm certainly open to discussing that with you.
But I just think having on the agenda at some point, one of the months, is to talk about what you all do. Look, and it's all risks, but in particular IT risks, but also privacy risks, there's geopolitical risks. Just talking about it with the council.
Absolutely. Okay. Thank you.
Madam Chair and Brent and Member Allen, I think that it would be a great time to talk about those things right after our audit is released. So Brent, if you can invite them maybe next time we meet to have a conversation, that it would be great, because we do, Kathy, we go over these things in our exit conference, and they walk us through their sort of requirements under, generally accounting general accounting principles and requirements for government auditing standards and everything else. And they kind of walk us through that, and it would be very important for you to see that. And they sort of check our internal controls as well. And we, in our exit conference, we did review that with them, and they gave us a clean bill of health when we go through that exit conference. But I think it's timely once the audit's released to review that and just have our auditors communicate, those results and just inform us on exactly what they do internally. They use a lot of technology in terms of their risk assessment and analysis and things like that. And so it's very, very thorough, and it really does help in terms of risk, having our agreed upon procedures that are reviewed timely throughout the month. So it's not just a like one time a year type deal. Those things are very helpful with managing risks in terms of feedback from our auditors. And what else am I thinking? That's about it. I think that it's just important that after the audit's complete and released, that they come back and talk to the council about it.
And to that end, I probably should also point out, this next fiscal year end is the last year end that Moss Adams will be auditing. So we'll have to go out to bid for new auditors. So it's probably a good time to have more expansive discussions on risk and what we're expecting from future auditors.
That's good.
That's when the budget hearing is?
So, Madam Chair, our House Appropriations and Finance Committee hearing is tomorrow afternoon.
Thank you.
Good luck.
Thank you.
And what's our next meeting? Is it gonna be here, or have you determined?
Yeah, we will get to that on the agenda, Member Allen, and we'll hear from folks if there's any change to our location. So I guess with that concluded, let's move on to the next agenda item, which is old or new business. Any old or new business before the council? Hearing none, our next meeting is February 25th. at 9 a.m.? And are we going to have the same kind of setup?
So, Madam Chair, we are looking for a better option where we can more easily fit more people in person. So we're looking at options, and we'll get back to you and the other council members very soon.
Just as a reminder, the cabinet room is closed during the session, correct?
That is correct. It's closed to us during the session. We don't know for sure if it will be available to us again after. That's not confirmed yet.
Finally, is there any public comment to be given?
Madam Chair, we did have a couple of people who signed up. They should be online here. This is, we should have Sam Khatib and Michael Zito from the Belay Investment Group. I believe the treasurer, I believe, suggested that they participate in public comment today.
Thank you. Hi, this is Michael Zito. Good afternoon, everyone. I'm a managing director with Belay Investment Group, and I'm joined by my colleague Sam, who's here as well, a VP at our firm. Our colleague Kelsey Harstead had previously connected with Treasurer Montoya a few weeks back, and she suggested that we join today's meeting to give a quick overview of our platform, which we're very excited to do. Unfortunately, Kelsey wound up having COVID, and she couldn't make it today, but both Sam and I are very happy to be here. Briefly, Belay Investment Group is a majority woman-owned real estate investment firm. We're focused solely on investing in the small and mid-sized transaction space of the marketplace. We are a pure play real estate company. That is the only asset class that we focus on, and this is the only strategy that we execute. And everyone in our firm's senior management has long real estate investment backgrounds. Our strategy is focused on actively investing over the past decade through a series of SMAs that we've had with CalSTRS, and we're now actively raising a new vehicle to deploy in the same strategy with various LPs. We specifically target the smaller real estate investment space as it's an area that institutional investors often do not get access to, and we believe it's an important part of a portfolio construction. While many LPs in the market have allocations to the known mega funds, they may not have access to the smaller cap markets and the alpha that those transactions will present. And Belay typically accesses that area of the market through programmatic joint venture structures. We do that with local operating partners and emerging managers that the typical institutional investor might not be aware of. And our ability to identify them early in their development allows us to, one, capture their proprietary pipelines, and two, at times achieve enhanced returns through GP profit participations, though deliberately we make the choice not to take GP platform stakes, which may often come with significant liabilities. Sam?
Great. Thank you, Mike. So just to quickly elaborate on this point, we see that institutional investors today face two main hurdles. One is access and alignment. On the one side, you have many of the best real estate opportunities kind of lie with the local and entrenched specialists or the emerging managers with deep market insights who excel at uncovering these unique opportunities. However, these managers often lack the scale or the infrastructure to kind of attract institutional capital. And on the other side, you have institutions that want diversified exposure to resilient markets, but often can't access the smaller, high-quality opportunities due to operational constraints or complexities of investing at that scale. And this disconnect just leaves immense value untapped. And that's where Belay comes in. We look to bridge the gap by providing capital, resources, strategic guidance to these early stage emerging managers, while also serving as a fiduciary to institutions through our expertise in manager selection, portfolio management, and differentiated deal sourcing. And we look to bridge this gap by uncovering opportunities positioned to benefit from the current market cycle, leveraging our network of over 800 operators to access unique first mover opportunities that institutions have difficulty accessing, and structuring partnerships through programmatic joint ventures, which allow us to secure GP and LP revenue streams, maintain control, and ensure alignment through governance rights without taking on any excess risk and liability. And the result is twofold. For investors, you get the streamlined, scalable access to high quality, smaller scale real estate opportunities. And for the operators, you get the growth capital they need to expand their platform, attract capital, and focus on what they do best, which is executing on real estate strategies. And since our founding, as my colleague said, we've had success with institutional partners like CalSTRS, executing the same strategy that we're now employing in Fund 4. And we've now built a team of 18 professionals, 3/4 of which are diverse. We've invested in over 140 transactions with 13 operating partners, growing the portfolio to over $2 billion in size, 65% of which of our exposure have been with diverse ownership. So I'm going to stop here as I know we're short on time and I want to be respectful of the agenda, but we'd be delighted to take some Q&A either now or later. But appreciate the opportunity to present today.
We appreciate you all being here with us.
Thank you.
Thank you.
Okay, with that, I will take in a motion for adjournment.
So moved.
Give me a second.
Second.
All right, second.
Okay.
Kathy?
We adjourn, folks. Thank you very much.
Thank you.